phase, which once in century phase is something we would all be absolutely willing to know. And I have the advantage of having a very rich and well experienced panel here. And thank you, Ishan and Varanya, again for introducing them. So I would go straight into the discussion. Uh, any such discussion does come just as when you have a puja, you try and worship Ganesha first. So in here, I think for financial sector disruptions, we have to understand what is the macro outlook, what is the background on which we have to understand the movement of the financial sector through the pandemic. So I will request Vivek to set the ball rolling for us. So and tell us in some sense about what is the current global macro scenario and what are the current trajectory for the Indian economy and how shall we come out of it? Vivek, over to you, sir.
Thank you, Tirthankar, and good morning, all of you. So, at the outset, let me thank everyone associated with the KIIT School of Management for having me here. And it reminds me of my college days, the trials and tribulations of holding such events. But I guess at the end of the day, it's the learning which counts, and every effort which goes into it makes it worth it. So, without much ado, jumping on to what Tirthankar has laid out, the pandemic has actually, you know, disturbed, I would use the word, disturbed a lot of preconceived notions. So, for example, not only the pandemic, even the global financial crisis, which we had earlier, there was a notion of things moving secularly. So there was a secular up move, there used to be secular down move, inflation used to move up almost everywhere in tandem. And now things have started to get questioned because there are disturbances not only on the supply side, because all said and done, the kind of recession that we are seeing, still seeing in some parts of the world, is something that was not seen in nearly 100 years. It's a supply driven shock of extreme proportion. And we had, to be fair, we had no idea how to deal with it. So we invented our policies along the way, and both from the fiscal side as well as the monetary policy side, the rule books were designed. Some of them were pushed to the extreme, and the results are still out. Some of these are still playing out. The pandemic has not itself sorted out. Yes, we have some clarity in terms of where we were 18 months ago. There is vaccine development. Hopefully, it is working. There's a fair bit of progress on that. Uh, the sensitivity of the shock to the pandemic is also sequentially reducing. So some of these changes are pointing towards the fact that our, you can say, adjustability quotient has gone up in the last 18 months. So people have started to learn to live with the virus at the individual level as well as at the country and the economy widely. So how is this having an economic impact? Well, once in a century kind of an economic impact, uh, the recession that we saw last year, it is quite natural to assume that with the kind of liquidity which was lost, with the kind of fiscal support that went in, and still, just to remind you, most of these policies are still very much in place, whether globally or talk about it domestically. So we are seeing a very strong evidence of a V-shaped recovery. You can argue that V-shaped recovery probably has taken a little bit of a dent in the last 2 or 3 months. But nevertheless, there is a semblance or a sense of a strong V-shaped recovery globally as well as domestically. So things which contracted 7% last year are expected to move up 8%, 9% this year. So something of this sort. Now, in terms of India, after the nearly 4 decade kind of an economic contraction that we saw last year in terms of our GDP, nearly 7%, roughly or thereabout in terms of contraction. This year, if you take a poll at this point in time, I guess broadly the market would be expecting anywhere between 9 to 10%. Our own in-house expectation is that, which is on the slightly higher side, we are close to 10% GDP growth with a slight amount of downside risk. But nevertheless, this is the band that we are looking at. If you would have done a poll 18 months before, I'm sure the markets would have been much bearish, or the expectations would have been much bearish. So things have moved along, things have changed. some of the policies are working, there is a lot of statistical base effect which is helping the numbers look good. There are also changes with respect to how the inequity with respect to the policy support is driving this growth. So the formal sector has cornered, you can say, most of the benefit from the accommodative policies, whether it is fiscal or whether it is monetary policy side. And this has led to a large part of profits getting diverted to the formal sector or the larger profit sector. So a lot of this recovery is actually being driven by them, and the that is something which is reflected. Agriculture, by and large, was to some extent insulated from pandemic effect. The sector was insulated, and services, as we all know, on the other side, bore the brunt. So services, as the economies, as the states are now unlocking sequentially, the services bit will come in very shortly. So incrementally, the recovery that we will see is likely to be services driven. And manufacturing, as I said, after 2 or 3 quarters, the V-shaped recovery in manufacturing actually had commenced. So most of the manufacturing sector at a broad level is already above pre-COVID levels or at pre-COVID levels. So that bit of recovery is more or less in place right now. Incrementally, it is the services which is going to join the back. So that is what is going to lead the recovery here on. And the flip side of this is that what is the price that you're paying for this kind of the price is both, I would say, ingrained or a consequence of what the kind of actions that we've taken in the past, as well as some bit of price that you're actually importing. So let's, for example, talk about inflation. Inflation is a direct consequence of what is being done in terms of supporting economies. And we are well, at the retail level we are somewhere close to 5.5, 5 to 6% band in terms of inflation. At the wholesale level we are actually in double digits. The recent number was as high as 12.5%. That's a pretty high number for WPI inflation. So inflationary threat is building up globally. Some of it is bound to spill over into our domestic economy also. And this is one thing that the policymakers will have to, on this part, tread very carefully. They'll have to start recalibrating their policy, start getting back towards the normal zone. Take their time, whether it is fiscal, monetary policy. Our own sense is that the monetary policy will be much better placed in terms of starting to normalize some of their actions. The RBI has already taken some bit of action in terms of recalibrating liquidity. We hope the interest rate part will follow soon with a reverse repo action. So that's on the other side. Is there anything else that we paid a price? Well, the debt levels have increased domestically, globally, and the fiscal deficit has ballooned. So there is probably a need to start looking at some of these numbers a little bit more cautiously, as and when you are more confident of recovery. So right now, the recovery, you can say that is somewhat still tentative, but in the next 2 or 3 quarters, you will be in a much better position to take a stronger view and start recalibrating some of these extremely accommodative policies.
Thank you.
So, yeah.
Thanks a lot, Vivek. I mean, thanks for that very well-rounded explanation of what's happening with the global economy and what's happening with India. Clearly, the next 3 months or more would tell us where we are in terms of our recovery. You also laid out the ever-rising problem of inflation, and especially double-digit inflation at the wholesale price level. So that is something again that policy has to keep in mind. The rest of the panel discussion I would like to keep in the following way, ladies and gentlemen. I'd like to ask each of our esteemed panelists about what kind of change they have seen during the last year and a half. Now we have the extreme fortune of having them from various parts of the spectrum. So we have Kumar and Nikhil, who are from large conglomerates. So they will bring their own perspective. We have Mr. Mohanty, who heads an asset management company, and then we have Vivek, who will give us the macro perspective. So what I would like to do is to ask each and every one of them about their perspective of how things changed in the last year and a half. What were they thinking in when the pandemic hit us in March and April, and Vivek pointed out, we didn't know, we were getting into the unknown, and how things changed, and how has that changed over the following year and a half. Following this, I would like to ask them, how would they see the next 5 years? I would like to request them to do a crystal ball gaze to tell us how they will see things pan out. Certainly, many things will, you'll see permanent change. Some things will not see for long. Everybody thought we'll be working from home forever, but now we are not. We're working from office again. So, what will remain? What will not? And I will also ask them for a wish list. What would they like to see change? In through the pandemic, what would be their learning? So I'll begin with Kumar. Kumar, your thoughts, please.
Sure. I'll start with basically when the pandemic hit us, how Wipro as a group we approached to the problem. Fortunately or unfortunately, Tirthankar, we operate in China, so we had a first-hand experience what is happening in China probably in the month of December and January. There is a historical say cash is king, and that always remains irrespective of whatever may be. And the word finance comes from that, and then money is related to that. So first call when pandemic hits you, nobody has seen this kind of event. We have seen probably the 2002 event, there is documentation available. We have seen the Lehman crisis, but this crisis is very different because everything is going for a shutdown. When this kind of event happened, the first thing is that keep the money available. I can remember exactly around 20th March, across all geographies, whatever the lines available, what are the cash available, it was kind of preserved. That's the first thing what as a corporate what we did. Because you never know how long this lockdown is going to continue. What will be the stance? What will happen to the banks? What will be availability of the money? That's the first thing what we did, preserve the cash. Number two is all about the safety of the employees. That's the second thing. Across the globe, because we are a large corporate operating in closer to 40, 50 countries, how we are going to address these issues. So tie up that part of it. Because at the end of the day, your biggest resources are your employees. Number three, as we keep on moving towards 15 days, from 20th March to the 7th of April, when the Fed, exactly went for the expansion, printing of the currencies, things changed dramatically. We understood that this is not going to be a liquidity issue. Because imagine a situation, 40% of the dollars ever printed has been printed in the last 13 months or 14 months. So that's the kind of liquidity what has been infused. So whatever the flows you are looking at it, may it be the equity market, may it be the commodity prices, may the energy prices, liquidity define fundamentals. Fundamentals never define liquidity. It's like if I give you a lot of money and I say you that I'm going to penalize if you keep this money with you, you're going to start spending. And here is a very interesting statistics. And this we noticed around precisely last year around May. This kind of debt to GDP, when you're printing this kind of currency, especially in the US, which the economy starts, the entire world kind of looks at the US. Post World War II, the debt to GDP of US is around 130%. The surprising fact was US was not the only country who was having this kind of debt to GDP. There were 52 other countries who were running that program. 51 defaulted. Only one country survived, that is US. How did they do it? Simply devalue your currency. It's like, imagine you have a house, you have taken a loan against that. Your house is 100 rupees, you have taken a loan of 100 rupees, your debt to GDP is, debt to your asset is 100%. You cannot decrease your debt. So what is the best possible way for you to do? Increase the price of the houses. It's like the price of your asset or the GDP is growing because you are devaluing your currency, the value of the currency is decreasing. That's very clear. And the number two, what we associated is that we are looking for a long haul. No government would like to lose its power, because the moment you start printing the currency, it's going to change the entire mathematics. Because with that kind of debt, if the interest rate spike happens, it's going to hit you very badly. Because today, if the interest rate is virtually zero, you can borrow anything. It doesn't matter because you don't have to service it. Debt is never repaid. It is just serviced. That's the first part of it, the financial part of it, what we saw it. Number two, one classic learning out of this entire pandemic is that we are reasonably a good group with a lot of strong systems, processes. But one greatest learning is that unless all of your customers, all of your value chain are not updated, they are not come to the same level of system, you will always struggle. It's like, I have a very strong view that down the line 5 years, probably the availability of the physically currencies might not be there in the world. That's easy for me to think and easy for me to do. But unless I bring the entire value chain to that part of it, it's not going to act out of it. So first measure what we did was that we thought the entire value chain, entire dealers, entire suppliers with whom we are working, everybody has to come to that same value chain. There is a cost attached to it. There is an effort attached to it, but it's an effort worth taking it, educating, bringing them to the same panel. Good thing about is that this is a 100-year event, but it's going to also prepare us for the next 100 years. And the pandemic says it changes your nature perpetually. People, like the biggest problem of Fed, if you go back, and every time they have said that we are looking for a 2% inflation. First time they are achieving a 2% inflation. And they're not feeling good about it because your unemployment is also increasing at the same time. There are paradigm shifts happening across the globe. One side, for the last 30 years, China with a lower production cost, with a weaker currency, they have exported deflation to the rest of the world. Today, China is taking in transition. They want to move to a consumption-driven economy. So you are looking at a stronger yuan, and you are also looking at who is going to start producing for the rest of the world. It can be, whether it's going to be Southeast Asia, the smaller countries, the answer is no. Whether it can be India, no, it cannot be. We lack that skilled labor. We can probably, go up to 10% or 15% what China does. It's going to be the bigger economies. It's going to be the US. So there are a lot of paradigm shifts which are happening. We are not looking at, cool off in terms of the asset bubbles, the asset prices, what we are looking at it. Because a lot of consolidation, what Vivek said, I'm just reiterating that. The unorganized to organized sector, there is a lot of consolidation which is happening and which is going to continue. Now, the fourth point, we see a lot of disruptions in the next 5 years. This is the view for the 5 years as we look to the mid of this decade or towards the fag end of this decade. What will happen? Who is creating the disruption? Is it the traditional banking channel? Is it the NBFCs? No, both of them are not creating it. It's creating the fintechs. So the two beautiful words coming together, financial and technology. If you go back to 2000, one of the largest private sector bank who became very successful, started the concept in India. We are not a bank. We are a technology company which is providing financial services to the rest of the world, to the India. And that's where the lot of destructive things, lot of constructive things which are coming in. Today, the situation is as such across the globe and entire Southeast Asia or in India. If a bank or NBFC has to do the trade finance, supply chain finance, they cannot go by themselves. They have to tie up with a fintech service provider. And that's what it is. We have so much cash flow which has been routed through all these trade finance, supply chain finance companies, and these valuations have gone on the roof because somebody is solving it. So that's what we will see. Number three, the dependency in terms of the human intervention. I'm not saying humans will not be needed. They will be needed in a better productive way. But definitely today we have the ability that your AI engines can do the same thing, can make the similar kind of decisions or better what a man is doing. Probably when you're writing a credit proposal in an industry, in a bank, a human will take, let's say, anywhere between 24 to 36 hours. With an AI engine, you can do it with 2 minutes. As long as there are financial companies which are doing it 30 minutes, and this credit underwriting abilities just goes out to the top 2 percentile of the underwriting skills, underwriting persons. So that's the kind of beautiful, magical things which are happening across the globe. So we see a lot of changes to happen, liquidity to continue, interest rate to be low. But the only thing is that once the central banks never create them empty, they print the currency, but you need a bank or a lending institution who can create the circulation of this money. So that is still not happen. As the economies will keep on opening, you will see a lot of money moving from notional assets to the real assets. That's the trend what we have seen. Are we out of COVID, the last point? The answer is no. Have we started living with COVID? The answer is yes. Because today, Australia and Germany have gone for the lockdown today, despite of all said and done. So we are not out of it. So it's a very uncertain world, but which will make us prepare. Liquidity will be available. So these are my predominant views. And technological innovation will continue to happen. Good thing, everybody will come to the same value chain.
Well, thanks a lot. I mean, I think you've laid out quite a wide carpet for us. You started with how preservation of cash was most important, safety of employees was most important at the beginning of the pandemic, and how through the pandemic we've seen there is this enormous fount of liquidity that's going to be there. You will also probably, have low interest rates for the foreseeable future. The idea because of is, because of the extreme amount of leverage that's there with many sovereigns and the adaptation. And, you also gave us a lot of opportunity in the sense of, China shifting from a production economy, devaluing its, growing by devaluation and exporting its devaluation to the world. And from there, we shifted to a consumption-based economy. Now, I'll ask Nikhil. Nikhil, how do we see large conglomerates responding to this change that Kumar has sort of laid out? Your low interest rates, you can't ignore fintechs. You have formalization all across. You have you come from a conglomerate that is linked to almost all parts of the economy. So how does your company behave, Nikhil?
Thanks, Tirthankar, for this opportunity, and thank you, Dr. Ray. Let me just kind of give a perspective. Just sit back in March 2020 when it all started. And if I have to say that when we were sitting in March 20, and as I look back today, it was Qayamat se Qayamat tak. You had a global financial crisis and up to COVID. So that was a decade which was behind us. And we were trying to look ahead to say that what next? And then COVID hit us. It was a very difficult phase for anyone to visualize and think ahead. Like Kumar said in a way that how long this will stay was the first question which was there in everyone's mind. It was completely unprecedented, to have all your dealerships shut down, to have ensure that nothing will come into your bank account as collections. It was unprecedented. You can have sales going down. You can have a dip in the volumes. You cannot have zero volumes. And I think it was a unique situation when in April, probably for the first time in the history, and maybe I will just say for the last time in the history, there was zero sales in the auto sector. So that is something which we had never seen. So how does one face such a situation? And again, finance answer will always be the same. Cash is the king. Everyone goes back to the drawing table. Everyone goes back to say that how are you going to manage cash first? What we did was slightly different, is that everything has to be kept simple. So just kind of looked at cash flow in two parts rather than looking at one cash flow, to say that what's my absolutely certain cash flow and what's my cash flow where I will not have any, or which could be subject to volatility, which could be subject to changes going forward. Why we had to do that is because, again, just look at it, it was happening in the month of March. It was just a Q4 was behind us, which means it was the best quarter for the production, for the sales. So you have payments to happen to vendors who would have produced all through the Q4. And that's what has to have come through in months of April and May when you don't have collections coming through. So that's the important planning which needs to be done. It was a difficult phase, but as you said, once we broke down the cash flows, I think probably things became much more crystal clear. What is it that we have to manage? What is it that we can probably look at a little later? And what we had to manage, we had to manage. So, and that included the entire ecosystem, as not only M&M, but it had to be dealers, it had to be vendors, because finally you have to keep the entire ecosystem running. So that's something that was an important part of the planning. I will say that looking at cash flow slightly differently, we immediately looked at our budget a little differently. We were looking into the next year, financial year. We said that, okay, we have a budget. Let's just split that budget into what is must have, what is good to have, and what can be dropped. And that immediately again gave a picture of what's must have is something which has to be preserved for everything. So we can plan for what we need into the future. So these are the small things which we did a little differently, I will say, but were very important to help us plan. And as we were, again, as Tirthankar, you said, not only operating in India, but we have subsidiaries in US, we have subsidiaries in Africa, Australia, Europe, everywhere. So it becomes very important to plan for cash, to plan for the borrowings, because while interest rates were at an all-time low, just remember in the March and April, the spreads went to all-time high. So the same in US, if you were borrowing at say LIBOR plus 100 basis point, in that month, people started borrowing at LIBOR plus 300 basis point. So that's the kind of spread increase because of the risk perceived by people on the corporates. The risk immediately went up, the interest rates went up. So you have to know that when you have to borrow, whether you borrow long, whether you borrow short, how are you going to manage those things? So there were a number of decisions to be taken. And I think it was an experience in itself. Once in a lifetime experience, a very different experience. And then Just fast forward to today. Again, at the risk of, I'm just touching up on M&M. We launched XUV 700, as you would know, just a month back. In first 1 hour, we opened the booking, 25,000 vehicles were sold. Next day, for another 1 hour, we opened the booking, another 25,000 was sold. And in flat 2 days, we had 70,000 bookings. So that's the kind of demand which is coming back. So now look at these two situations, and as a treasury head or as a say a CFO or for the finance department to plan out when things had come to a standstill and when things are coming with such a euphoria and such demand. Now look at just the global scenario. You have 2019, 2020, which was kind of a growth shock. You had this year, which is an inflation shock. And going forward, probably you will have an interest rate shock, looking at how the inflation is going. So these are the kind of things within which you have to operate. And why did I say Qayamat se Qayamat tak? Because I just, out of interest, I looked at this phase. And thanks to Mr. Erdogan, who just day before yesterday in Turkey gave another rate cut, we had exactly 999 rate cuts from Lehman till now. And he made it the 1,000th rate cut when it was least expected from any country. And we were post-COVID, the liquidity which Kumar talked about was being pumped in at the rate of $800 million an hour. Now that is going to come off. And when that comes off, how are the financial assets going to be impacted? Because this liquidity has gone to financial assets. See, most of this money has gone into the hands of rich people, and it has gone through savings, it has gone through financial assets. So when that comes off and the financial assets now come off, that's going to be another challenge for corporates to manage, because the volatility is going to be at an extreme high. It's a very, very interesting times we are staying in. 2020, the world was in a completely risk-off situation. The highest earning commodity, the financial asset was gold, and the worst was commodity. And just come this year, 1 year later, the best returning asset is commodity, the worst performing asset is gold. So we are completely moved from a risk off to risk on. So that's the world we are in. Corporates have to be prepared. As I said, that we are planning, we take everything, we take quarter by quarter first, and then we also look at long term, because we have to plan for both. So when we decided that we have to go out and borrow more for exigency, not that we required funds, the first thing that we did was knowing very well that these times are uncertain and one doesn't know when the demand will come back. We did a perfect mix of long-term, short-term, variable, fixed, so that out of whatever we did or whatever we borrowed across the globe, half of it stands repeat, because we know we don't need it. And at the same time, when the rates went down, we could actually take further advantage of the rates going down. So I will just say one thing: speed, agility is what you require, faster decision making, and probably keep things simple. Don't get complicated. You have to be sanguine. You have to know that you have to keep hope, and life becomes simple. But times will be difficult. Times will continue to be volatile going forward, and we just have to be cognizant of what we are doing, how we are doing, and not panic. That's the only thing that I can say.
Thanks. It's a lot, Nikhil. I think your mantra of keeping things simple, and differentiating between what is needed and what's not, and what you mentioned about differentiate your budget across what's must have, what's good to have, and what we can postpone. I think that is something that one needs to have. That's a quick learning and very important learning for corporates, and that have guided themselves through the pandemic. I have two takeaways from what you were saying, which would be very good questions for our next speaker. You said liquidity is at an all-time high, and this liquidity is going to come off now, and it's going to affect financial assets. Financial asset valuations are sky high, as we all very well know. So, and you also mentioned how companies, it's also smart to probably borrow across the term structure. You don't know what you will need, you don't know when you will need. And once, things more, start stabilizing, at that time you can retire your debt what's needed, where it's not needed. But two things I have for my next speaker, Amitabh, who is the CEO of an asset management company. Sir, I want to ask you, Nikhil's point about this sky high liquidity is going to come off. Nikhil also mentioned that, you had a growth shock, then you had an inflation shock, which is very likely upon us. And then as this global monetary policy stance starts unwinding, you'll also have an interest rate shock. What do you think will happen with financial assets, Amitabh? Amitabh, you there? Ladies and gentlemen, until Amitabh joins us, I might route the same question to Vivek. So, Nikhil's poser on this inflation shock, this interest rate shock, how soon do you think this will happen, Vivek? I mean, I'll tell you why. One of the things that we heard from Kumar was that there is an enormous amount of debt. US was the only large economy that did not default from such high levels of debt GDP. So,
I think Amitabh has joined.
He has joined us.
He's joined.
Has he?
I just saw a message. He's a co-host.
So, Amitabh, are you there?
Anyways, we can go ahead.
Yeah. So, Vivek, if you could handle that question, we have this, interesting conundrum. Growth is picking up, but we have this.
I'm here. Tirthankar,
Amitabh, please. So,
so there was some problem with my unmuting, I think.
No problem.
So anyway, so this is a challenge which I think is facing all of us, and especially for fund managers who are supposed to be the best in predicting events, although track record is not that great. So that's a challenge which we are all facing. The world is facing the problem of how to unwind this liquidity, the trajectory that needs to be followed, and every time one seems to figure out that, okay, this is now the time when it should get unwound, you are seeing again cases of COVID again spurting in different parts of the world. But be that as it may, one needs to just step back and figure out that this hugely significant amount of liquidity which has been infused into the global system was to address a black swan event or a Six Sigma event, if you may. Clearly, the world, while it's still grappling with COVID, it's in a much better situation. You are seeing other macro parameters starting to come front and center. You are starting to see inflation being a bigger issue going forward. And therefore, I think even if COVID starts spurting up in a few areas, I think the journey back to normalization has to start. So from a fixed income perspective, obviously, from any asset perspective, you have to move away from risk on assets, start to moderate your views, maybe go to much more duration neutral kind of exposures, maybe go to in the equity space, go to those areas which maybe old economy, if you may, which will participate in the infrastructure building, in capacity building, as demand starts to normalize, and a lot of those assets still have good value even in this frenzy. So the point is, one needs to start looking to move out of risk on positions to risk off positions. But we get this question a lot, and unfortunately, we are in no position to predict the timelines. But I just look back at a few of these frenzied events which had happened, 2002.com, 2006. The outcome becomes very nasty a few quarters or maybe a year or two out, and that is something that maybe the corporates, maybe fund managers like us, and the regulators need to be very careful and start preparing. You leave it for too long, then you'll have to do that much more to get ahead of the curve. And my biggest worry is the central banks, the regulators, etc., are still pandering to keep the bullish sentiment alive rather than start talking the market down a bit. What has been very interesting to see is a lot of trend changes have happened, as I had mentioned before to you, that some of these amplitudes have got magnified. Those amplitudes will moderate as normalization happens. But a lot of innovative techniques which have come in, various processes will continue to exist and continue to bring about huge changes in the productivity. From our perspective, one interesting thing which had happened when we faced COVID initially, obviously, as you would know, most of the financial centers are prepared for disaster recovery and business continuity. But the way we had designed this was create another center, maybe in Hyderabad, maybe in Bangalore, maybe in Vashi, a big data center where 50, 100 people can go and take over the work that we are doing at a normal business centers. No one had ever envisaged a situation where disaster recovery means every household of every employee becomes a backup center. Each laptop has to become a backup. So it required a lot of changes in the IT security for some time. When we were putting those security measures in place, we actually had to remove certain features from our customer facing websites because lot of security measures had to be temporarily suspended to ensure that employees could work from their households. So it was a big learning for all of us, and I'm glad to see that we all came up the curve, and all these learnings will stay with us. It will impact the way we work. But even if you look at what Jamie Dimon said, that at some point of time there will be certain activities which you can carry out from home with equal effectiveness, but for some activities you do need to come back to office. There needs to be free flowing interaction with colleagues and other humans. Ultimately, however much technology picks up, takes up, starts substituting, human beings as human beings have to interact, and that I don't think is going to go away. It might get modified, it might get changed, but it will be around more than what a lot of people think it will. So that's it from my side.
I think, thank you. Thanks, Amitabh. I think you made some very interesting points. There's no taking away from human interaction. And I think that is something one must sort of learn. If I would say the big change since March 2020, in terms of people's perceptions, was how one would shift from work from office to work from home, how work from home is so good. And now people do come back and say, no, we have to do some part of our interactions in from the office. People have to interact with each other. You can't really be behind a Teams or a Zoom call all the time. Things have to come back to normalcy. You also posed some major hurdles for us. You said in terms of whenever the unwind happens, whenever does it happen, it could get quite nasty a couple of quarters out. And this question that you pointed out, that central banks are continuing to pander to bullish sentiments. So I had two sort of linked questions to Vivek, because let me go back to the macroeconomists. So Vivek, if what Amitabh says is going to happen, we have, let me put this, our MPC has said that the current growth is uncertain, and that is why even with inflation remaining high and inflation continuing to see some kinds of numbers spiking up even now, the MPC says growth is uncertain and they would like to continue their accommodative stance. So the MPC could be right. It's possible that growth needs support at this point, or as Amitabh is saying, and which is something that we are seeing from global macro events, from IMF's World Economic Outlook in October. IMF has said central banks have to be very, very vigilant. This is strong commentary from IMF. It says we have to be very, very vigilant about inflation going forward. So do you think this unwind can be a really nightmarish scenario, as Amitabh is saying, or can we come out of it unscathed? The point I also want to, Vivek, you might want to add is, so this is the financial sector. This is the financial sector at peak valuations, massive liquidity. And then there's the real sector. Can an unwinding of the financial sector meaningfully affect our growth trajectory? Can that be another disruption?
It's a fair point. I think the points raised by Amitabh and even the earlier panelists, they are worth considering, and they probably will be the theme going into next financial year as well. So, in the middle of the pandemic, we instituted ICU level policies. So they were very typical of ICU level policy, the kind of accommodation that we saw globally as well as domestically. Now, as we are now seeing some semblance of growth coming back, as now we are seeing some semblance of at least partial level of confidence coming on the COVID front. And if there is no virulent attack from the COVID side in the next 6 months, then these policies need to be withdrawn. I mean, you cannot keep on operating where demand is coming back and with vengeance in some of the sectors, as I think Nikhil also pointed out. So you'll have to start recalibrating because you cannot permanently operate with an ICU level accommodation. So you have to start weaning some of the economic participants from the accommodation that you've provided. And how do you do that? Well, obviously, the first step is to start communicating, and you have to start preparing the market participants about what you think. Just looking at the fact that your headline inflation is very close to the target, and there is a lot of statistical base effect which can, you know, kind of dilute the messages from the statistics because of the COVID. You have to look at it in totality. If the headline inflation for India is close to target, there are also incipient pressures building up because what is bringing it towards 4% handle is a lot of base effect support, a lot of cyclical component to it because 46% is our food basket and CPI, and that has been thankfully behaving somewhat in our support. So that is keeping inflation on the lower side. Whereas the other side of the equation is extremely concerning. You have record high fuel inflation. You have almost record high core inflation as far as CPI is concerned. And these are not cyclical. So there is an element of COVID disturbance associated with it. There is an element of a lot of revenge spending, a lot of pent up demand, which is getting reflected, a lot of imported price pressure, which is also getting reflected. The MPC will have to start. The MPC so far has communicated that it is fine as long as inflation is within the target band. For us, the target band happens to be 2 to 6%. In effect, what they are operating is the 4 to 6% band. So they say, according to them, if as long as the growth is uncertain, they are happy if inflation is within this band. So that's a fair point to make, at least in the last in the last 18 months, where the uncertainty with respect to growth was extremely high. Now, with some of these uncertainties getting addressed, now with greater, I would say, vaccine penetration, at least the ability to start living with the virus is also now is there. So growth probably the growth situation will start looking much better as we move forward, and the MPC will should, in our opinion, start according equal amount of weight to inflation management as well. So we think that they need to do it, and they need to do it in the most non-disruptive manner. Start communicating with the market participants. Well, they have on the sly started doing it already through liquidity. The idea is obviously to start calibrating the short-term money market rates. So in effect, they are signaling that the effective policy rate should start moving up from 3.35%, which is currently the reverse repo rate, and start moving towards the 4%, which happens to be the quote unquote the normal policy rate. So the idea first should be to move from ICU to a normal policy setting and then start looking at tightening policy. So tightening policy is still about a year away or maybe 2 to 3 quarters ago. But at least in the interim, I guess it is extremely important for them to start guiding markets towards moving from ICU level to a more normal level of monetary policy setting. Will this be disastrous? Well, I guess it all depends because if 2013 was a disastrous experience for us in terms of the taper tantrum, then I guess 2021 or 2022 probably will not be much. There will be some spillover, but our main source of external vulnerability is much lower. We stand at a record high FX reserves. Our debt ratios vis-a-vis FX reserves are much more beneficial. Our reserve cover is close to an all-time high. So some of these external sector ratios will probably insulate us from extreme amount of volatility. So we will expect some spillover, but those spillovers are not likely to be disastrous.
Thanks, Vivek. There's a follow-up question to both Kumar and Nikhil. If external vulnerability, as Vivek points out, is relatively more comfortable versus what we saw during the taper tantrum, both your firms operate across the world. Do you reflect these sentiments? Do you agree with these sentiments, Kumar?
Yeah, see, I have a slightly contrarian view. Firstly, we're not talking about unwinding of the liquidity which has been printed. We're only talking about the tapering, starting from the US. We're just seeing the way, the intensity or at the speed where the money was being printed, that's going to be reduced. No, US has never actually unwound their balance sheet. Historically, from 1941 onwards, they have never unwound their balance sheet. They have remained that only the pace at which they print the currency that has slowed down. That's not point number one. Point number two, given to a fact, our FX reserves are so high today where we stand as on today. We are almost 18 months import cover, which is available with us. So an external shock, vulnerability to the rupee, we are kind of muted. Number 2 point. Number 3, which is slightly different for the point number 2. The moment you start, protecting the rupee depreciation. So what you technically do is that you sell dollars and you protect the rupee, but you take out a lot of INR liquidity, the systemic liquidity which has been maintained in the system. But if that happens, somebody can argue that through OMO again you can push that money to the system. But if you start taking the rupee liquidity out of the systemic liquidity, then you have a risk of defaults. Because today, a lot of financial sector, maybe the banks or the NBFCs, especially the retail sector, which are operating in the rural side of it, anywhere the gross stress assets would be closer to 10%. The microfinance book or the two-wheeler book. And if you look at the reports, anywhere the banking stress assets would be around 7 to 11%. So if that's the kind of number and you want to take the systemic liquidity out of it, the availability of the money becomes difficult. Right? And it doesn't take long in India to dry up that kind of liquidity. That's point number 1. Point number 2, if you look at the stance of RBI, they're very comfortable, and what we keep on hearing is, whatever is the forward premium, they're okay to allow the rupee depreciation to that level. Like we started the year around 73.5, 74 level, forward premium was around 3.5 rupees. But till 77, 76, 77, we are okay. It's not about, an depreciation of 10%, what we have seen in 2013. But 13, we also need to remember one fact. Fed did not give enough time to the market to prepare. Today, there is enough signaling to the market. Markets are prepared. Financial corporates are prepared. So that's the broader part of it. Number 2, coming to the inflation. Look, we operate in Malaysia. We procure your crude palm oil from Malaysia. If you take any indicators, giving the supply, giving the reserves, the crude palm oil prices needs to come down. But it is not coming down. It is almost 3x of that price. Okay. So just by tweaking the interest rates or managing the liquidity, you can bring the inflation down. The answer is no. Because you have a supply side issue. You have a serious freight issue. You have a commodity speculation going on. At the same time, 3 of your largest agriculture producing countries, export driven countries, US, Canada, and Russia are very clear they're not going to do the export the way they used to do. So, and the 4th point is crude, coming to the crude part of it. There is a saying, when the economy is not doing well, it's the crude OPEC basically pays to the rest of the world. And when the economy is doing well, is the rest of the world pays to the OPEC. Because, through keeping the prices high, you compensate them. If I add 4 of the points, and of course, China taking its reverse in its stance, the starting point of inflation is not because of the liquidity. It is because of various other facts, which is going to create an issue. So central banks are cognitive of the fact. See, today in India, the WPI is around 12%, CPI is around 4%. Sequentially, you can say that CPI is around 5%, WPI is around 11%. So at some point, this price will get transferred, and it is getting transferred, because we have seen in the FMCG sector, we have shifted around. We have, prices have gone up by closer to 30% in the last 3 to 4 months. So the inflation is there, but what we are looking at as a CPI, which is your 46% is your primary articles, and then there is your 10%, which is your urban housing rates. There it is not getting reflected, because nobody wants to go to urban and go for rent, and that's where this 55% is helping you to keep your prices low. On the contrary, non-discretionary, inflation is going up and everything else is happening. Because if 55% is down, your CPI and the divergence in both these indexes in India, you will keep on seeing. So if a central bank, through the liquidity or through the interest rate, can manage the inflation, they would happy to do that. But they are cognitive of the fact it is not possible to do that. So I don't think, a sharp rise in the interest rate is likely. Probably you might see, reverse repo going to 375, and then probably in a down the line 1.5 years, it is going to 4.5 kind of repo, or at best case 575. But we will not go back to what it used to be pre-pandemic, at least for next 2 years. Number two, if you look at the 10-year govies in India, it is almost back to the pre-pandemic levels. Rather, it has gone beyond that. But at the same time, you take the curve from 3 year to 1 year or below, still the interest rate is far, far away from what it used to be pre-pandemic. Still, there is a lot of compression, and today a corporate can typically borrow in 1 year at around closer to 4% or 360. That's the broader horizon is all about. So government is comfortable. We will borrow in the longer end, 10-year, we'll keep the rates elevated, and corporates are getting the money in NBFCs. You borrow the money there. So there is a lot of divergence in CPI, WPI, divergence in the tenor spreads, all are happening. So I don't see an external shock that kind of, because today we have all the arsenals by the central bank, number one, and they are cognitive of the fact that they cannot inflation through these measures. Liquidity is available in ample, and if they suck out the liquidity, then they are looking at an accidents. So if I marry all the three statements, none of the government across the globe, may it be Malaysia, Indonesia, China, Israel, UK, Germany, or US, or Brazil for that matter, nobody is in a mood to give a very sharp shock to the economy. So it's going to be a very, very muted affair. It's going to be in slow pause.
This is good news. This is good news for markets. Thanks, Kumar. Appreciate it. I have, given the time that we have a couple of questions coming in, but we have, I think, from the schedule sent by Professor Ray, we have 10 more minutes. I have two follow-up questions to my panelists before I can actually go to the questions. So my first question is to Nikhil, where Nikhil, this, if the global situation is so sanguine, you mentioned to us how, you had record starts for the XUV 700. I mean, congratulations on that front. But then let me also, bring your attention to the current supply disruptions that's happening. Those are happening in the global supply chains at the moment. There is an acute shortage of chips, and auto companies are feeling affected in a meaningful way. So, Nikhil, to you, the question will be: how do you see the auto industry coming up with a response to this disruption? And to Amitabh, the follow-up question is, if things do go back, last 1.5 years has also been one era where Indians have started looking at equity, whether directly or indirectly in a meaningful sense. The number of accounts with the National Stock Exchange, UCC accounts, has gone up to about 5 million, and 10 million of which came in the last 7 months, and the previous 10 million came in the last 15 months. We are looking at accelerating growth in terms of Indians coming to the markets. Indians are also in the last several years have looked at mutual funds in a very favorable way. Do you see, when this liquidity pound starts drying up, the inevitable problems that will happen in the financial sector? Yes, Kumar gave us some comfort that it will not be, nobody would want to rock the boat. What do you think will happen to this behavioral change that has happened to Indians? I'll start with Nikhil first. That's my second last question, and my last question will be to Amitabh before we can take up other questions. So Nikhil, if you please. What do you think?
So I think while people were caught by surprise when the chips issue came up, I will say that it's a matter of time before it will be behind us. It's affecting the entire auto sector globally in equal way. It does depend on how someone can now kind of prioritize and look at how they can kind of divert production towards priority vehicles which are in demand. So that's how people will be managing in the interim. But I don't expect this problem to remain unattended for a long time. I think probably it also gives India an opportunity. We don't have any chip manufacturer. That's something we should be looking at. As that could be an interesting area which could have a good amount of demand going forward. But I will just keep it short to say that it's a global issue. Let us see how it gets sorted out, and auto industry will definitely come out of it as you see the demand picking up. I think that's what leads to innovation. That's what leads to change, and that is what also will come up as you auto industry is having a lot of headwinds. Not only that, you are also transitioning to electric. So all of those things are going to happen. So there are too many things happening at the same time. I will say that things like PLI, which have come out, will definitely help in a big way as you try to maneuver through this phase. So one will have to be positive again. What I would just like to say is probably what is important is the way I look at it. Again, just give me 2 minutes on this, but I think India is on the cusp of a very, very positive period. And that's what is going to help not only auto, but any industry which we are into. Again, the same, I will just use the same logic, of Qayamat se Qayamat tak. We had a lost decade. India had a lost decade in a sense because of various factors, whether be it tapering, be it demonetization, be it short-term impact of GST. GST is a very good change, but the short-term disruption because of informal getting into formal, we had the trade, international trade issues. So all of those impacted us in some way or the other. But we are sitting at a position where banks are right now well capitalized, okay, because of what the way the situation was. The bad loans are very, very well provided for. 60% of the provisions have been done for all the bad loans. Corporates ROE are increasing and are in a better position. They have deleveraged to a large extent if you see the Indian corporates. So the borrower is ready, the lender is ready, the capex cycle is set to begin. And I think that we should be leveraging this and taking advantage of this situation. Probably it's a very, very good growth phase. I will also agree with the fact that the interest rate impact will not impact us for various reasons. While interest rates may still go up, we also have to see that we have a chance of getting included in the bond index, which itself means $40 billion coming into the economy, which means there is going to be a demand for the Indian paper, and therefore the interest rates will be kept low to that extent. So that's a very critical point we have to be mindful of. While RBI has a lot of reserves, you can also see that RBI has typically intervened more when India's rupee is appreciated rather than it is depreciated, if you look at history. So the point is that it lets rupee find its own level. And considering the situation India is in, I don't expect a very sharp depreciation of rupee. So we would be able to weather the tapering and interest rate hikes globally very well this time. India is on the cusp of a very well-defined growth, I will say. And whether it's auto sector or any other sector, it should be a positive phase for us.
That's so heartening to hear. Truly so heartening to hear, Nikhil. And I hear this sentiment across, and I kind of tend to agree with it. The last decade has been truly, in some sense, a lost decade. Corporate deleveraging, the big expected pickup in private capex, and how banks are so much better capitalized today, and versus they were about 5 years back. All of it lets us believe that we are on the cusp of a halcyon period, so to speak. Thanks for that, Nikhil. My question to Amitabh: what happens to the new retailer, the new retail guy to the markets?
See, more than me, I would refer you to lots of tweets that the biggest beneficiary of this retail boom, Zerodha, and its founder Nitin Kamath have said. I follow him a lot. See, there will always be, as I said, the trend has got entrenched. The trend is not going away. But as I said, the question is on the amplitude, and it is quite likely that a lot of the newbies in the markets have not seen a bear market. If they see a fundamental shift in valuations and an extended period of corrections, not so much because of the state of the real economy, but plainly because of the slightly frothy valuations, there will be some drop-offs. There will be some drop-offs, and we'll have to be prepared for that. See, I'm slightly old school in this. I like to comment on the strength of a trend after it has gone through a cycle. It's slightly should I say ambitious to comment on the cycle on the trend when it is at the peak of a bull run. So let a cycle continue. Let's see how it pans out after a period of some amount of consolidation or correction. But having said that, the moves ahead will happen through Six Sigma events, which work as catalysts. The trend was already there. The trend has got accelerated, but we still have a long way to grow. If you look at equity mutual funds, we are at around 5 to 6% of GDP, whereas the world developed countries at around, I think, 30%. The mutual funds at large are at around 75% of GDP. We would be I think 16, 17%. So we have a long way to go. But the point that I'm trying to make is it's not going to be a secular linear uptrend. There will be volatility. And the biggest thing which all the retailers and us as fund managers and as corporate leaders have to watch out for is the volatility, because the volatility is determined by the delta. And if the delta swings, the impact on volatility can be reasonably significant. And that's what we tend to overestimate risks during bad times, and then during good times, we tend to underestimate risk. I think what the world has told us in the last 18 to 20 months is prepare for risk. Don't try to figure out where it's going to come from. It's going to come, and you should have to be prepared for uncertainty. That's I think, the basic message that all of us have received well and clear.
I have the same healthy skepticism, Amitabh, and that's why I wanted to. It's nice to see the same thoughts getting reflected. But I think Nikhil, you wanted to say something, added something there.
Yes, just one point I wanted to touch upon, because I think it is important for today's forum, since we're talking about transformation. So
Please.
While I say this growth and everything is there, I think the most important point is that we have to look at digital in a big way, because that is not a good to have investment any longer. It's a must have investment. And that is something which will be very, very critical if we have to leverage this situation which we are in. AI, ML, these are no longer good words. They have to be kind of part of our embedded in our systems. And if we don't leverage that, then we will be missing this opportunity. So that's a we have to invest in cyber security. We have to invest in digital. If we don't do that, I think we will be worried about it after another decade.
Tirthankar, just a small addition. Look,
yes, Kumar.
With Nikhil, I'll take not less more than 10 seconds. See, previously all these systems were being implemented by the chief information officer or the CFO joint. The actual finance guy were never coming forward. Today the agenda is, let's say, with the treasurer or with the CIO or with the finance department, how to drive it. So that's where the beginning is happening. Previously, systems were being chosen, and there were a lot of back-end agendas, which is the DOSAs, decision-oriented systemic approach, to prove that no, it is very successful. Today, the drive is coming from the treasurer or the finance guys or the collection guys. So that way, there are a lot of revolutions which are happening.
I couldn't agree more.
So Tirthankar, just a small thing, since we are on a panel of an event of a institute, what I would leave as my final thoughts possibly is the role of big data in all this. Okay, as more and more transactions are coming through the digital form, big data is going to play a big part, and that's where the biggest transformation is happening. Strategies will become more micro-oriented than macro-oriented, because we have more data to predict customer behavior, customer profiling, etc. And I think colleges like KIIT, I think they need to now come up with very, very contemporary, relevant disciplines in the area of data management and data sciences. I think that's something that will be very relevant going forward, irrespective of how strong the trends are or not. This is come home to roost, and I think we have to train our next generation to be absolutely top of the class in these regards.
I couldn't agree more. To be honest, this is where one feels sort of hamstrung by the time that's given for a panel discussion. We have started the day with a panel discussion here. There are other programs during the day, and one would not want to barge into their timings, but both the points, Nikhil, you made, Kumar, you made, Amitabh, you made, all of them are very, very well taken. And to be honest, each one of them, deserves a separate discussion of its own. And even then, I think we will be able to do only scant justice to it. Before coming into NSC, a terabyte was large for me. At NSC, we deal now in petabytes of data. So that word is no longer English. I've actually seen a petabyte of data. We work on a petabyte of data. So big data is data is something that's that's the future. It is the while. I mean, I can keep giving more and more stuff about this, but if you may, gentlemen, we should move to the question answers of this panel now. Let's see what we have in store. So let me start with let me do a LIFO here, last in first out. So this question is, with the slow decrease in circulation of fiat money and the increase in crypto in the market, central banks are still fighting to control the direction of the economy. How is this digital change affecting companies and policies to ride this change? So Nikhil, for you?
I think crypto is still a point away. We have to keep in mind that most of the central banks are coming with their own digital currencies. And that is what is going to be the legal tender which will be there, and not the cryptos which we are going to have. So that while crypto as a financial asset is today getting value, I have my own thoughts on that. There is no intrinsic value behind it. It's more a scarcity value or probably a speculative value to it. But we will have to be again very cognizant of the fact that this is not, while it started as something which could come as a legal tender for exchanging values, it is not something which is getting support. It is not regulated in that sense. All the central banks are coming out with their own digital currency, including India. So what is the future of crypto more than as a financial asset and its scarcity value is something we will have to look at. I think companies can look at it, if at all, while not conservative companies will never do that. As an investment, you can look at it, but nothing beyond that for now.
No,
Just in addition,
yes,
in case you believe central banks want to lose their power, then crypto has a future. If you don't believe, crypto has no future.
I mean, the whole idea about fiat money is not going away. So, another question that we have is, startups are coming up as well as getting IPOs. They're converting themselves as unicorn. I will add here, India this year has seen 35 unicorns, which is more than the sum of all the unicorns since 2013. What's the impact on the economy? So, Kumar, Amitabh.
Sure. See, I run a venture fund where we only invest in the startups. Okay. So let me answer this question in a very different way. What are startups? Startups are nothing but the zero coupon bonds where entire cash flow is at the rear end. You don't know whether you will see the cash flow at the end of the tunnel or not. But valuation can be created. Of course, valuation can be created out of it. You can make money out of it because the bond prices, intrinsic value is going up. Whether cash flow is going to come or not, you will not look at it. One of the food companies, where they're talking about they will only see the profitability after 18 years. Unimaginable kind of things. But you also need to take this thing with a pinch of salt. Dance the point of time till the tune plays.
Yes.
10-year US Treasury yields at 1.8, you have an issue. It goes to 2.5. Where these assets will go, you cannot see that. So it doesn't take time to vanish. So dance till the time of the music plays. Only thing is that stay close to the door. So that's our take on it. Just to anecdotally say is that 18 years profitability of Tata Steel is the valuation of one of the newly listed companies. How can it marry?
No, we are in an interesting world. I mean, there is the Chinese curse, right? May you live in interesting times. I don't know if it's Chinese or Japanese. That's where we are. We have companies with zero revenues getting $100 billion of valuation. Rivan and so yes, let's see how long the music sort of goes. So one question to Vivek here. Vivek, how has inflation affected the purchasing power parity of India and other countries? This is from a student, so you might want to make it simpler. You're on mute, Vivek.
Yeah. So now I guess So inflation by and large globally is playing along the same lines. So barring India, which probably at a CPI level is seeing, if I can use the word moderate inflation, whereas inflation is high across the globe. And the reason why India is kind of standing out as far as CPI is concerned is because we had a terrible time last year in terms of inflation, whereas rest of the world had a very good time as far as inflation was concerned. Inflation was extremely subdued last year for the globe. Inflation was high for us. So now things have come back to a turn. We are seeing somewhat moderate inflations on CPI basis, whereas the rest of the world is now in the other side, on the other side of the fence. So in some ways, it's kind of neutralizing. So we are also living in a world where our inflation on CPI is nearly 150, 200 basis points lower than US. I don't remember in the recent history when was that a case, as India's inflation is nearly 150, 200 basis points lower than US. But leaving aside these, if I can borrow the term which Amitabh used, these are nothing but amplitudes. And the overall trend that if you have to look at it from a cyclical perspective, then India's inflation, I guess, is getting anchored around the 4 to 5% handle. And to a large extent, I guess the commitment from the RBI or the formation of the MPC, at least there is now a policy mechanism to address these. There is a rule-based policy decision making to some extent. And hopefully this rule-based policy making will also get into the start getting reflected on the fiscal side as well. So if you have some degree of credibility from the policy side, then by and large you can assume that India's inflation will get anchored around the 4-5% level. This I'm talking about from a trend basis, because I would not really want to comment about what has happened in 2020 and 2021, because there is a lot of noise in data. And globally, there is now an acceptance of the fact that inflation is or could and should be somewhat higher than 2%. So most of the developed country central banks are now more accepting of the fact that they can look at inflation somewhat higher than 2%. So this average inflation targeting concept, which was recently introduced by the Federal Reserve, is also seeing some bit of support from the European Central Bank. And if more and more central banks, at least on the developed country side, become more accommodative with respect to their idea of inflation tolerance, if the 2% threshold moves towards 2.5%, 3% threshold, then I guess from a purchasing power parity perspective, India can stand to benefit. And this should also get from, and this again I'm talking about from a longer term perspective, at least from a 5-year perspective. This should also start getting reflected in your currency value. So if I'm able to anchor inflation around 4-5% on a trend basis, my currency should not be depreciating by 4% on an average basis. And I think this is a point which Kumar brought out, or maybe Nikhil brought out, that this is something that RBI should be extremely comfortable with. Anything around 4% level on a trend basis depreciation. I guess the central bank would be extremely happy.
Kumar actually mentioned that RBI is going to be probably compatible with a depreciation to the extent of the forward premium. Am I right, Kumar? Yeah,
that's true. That's true. Just a different addition, in US, households are sitting with 2 trillion surplus cash. Households, just retail households. So if you have that kind of money, it doesn't matter where the inflation is, you will still spend.
So we have more questions, but I heard this mechanical voice telling me that recording has stopped. I think we've passed our time by about 11 minutes now. So I would say, ladies and gentlemen, thanks ever so much for attending this panel discussion. And I think I still have one message here. Yeah, we have more questions, but we don't have really time. So thanks a lot. We did go through a number of topics here. We started out with the macro backdrop by Vivek, and then we had views from Kumar and Nikhil in terms of how their conglomerates behaved at the beginning of the pandemic and what has been their learning. We also had views from Amitabh on how assets are, what is happening with assets in the current scenario, how valuations are inflated, and how we need to be careful about the change that's going to come up. One other important point that he made was in terms of preparation for the future. Big data is something that one can't really ignore anymore. These are things that need to be kept in mind for change. Of course, one other point he also made that a lot of change that is there. One has to see the amplitude of that change. Many things may not see the same change going forward. So one has to see how the overall world would behave. And clearly, as I think Nikhil pointed out, we live in very interesting times. Truly, it is Qiyamah se Qiyamah tak and beyond in some sense, right? So on that note, on that high note, I thank everybody. I thank Amitabh, I thank Kumar, I thank Nikhil, I thank Vivek, and I thank the KSOM for giving us an opportunity to bring this to you together. And on that note, I will sign off on this panel.
Sure.
Thank you.
Just a small addition, Tirtha, I forgot to mention
Please.
that I actually did my graduation engineering from KIIT University. So it's a pleasure and privilege to come back and speak again in the same university. It's a privilege.
You are a distinguished alumnus, Kumar. I mean, compliments on that.
Thank you.
Thank you. And I pass over now to Ishan and, again, Ishan. Yes. Please.
Thank you.
Thank you, sir. Thank you.
Yes, over to you, Ishan. Thank you.
Thank you, sir. Thank you, sir, for this insightful session and covering all the aspects of today's panel discussion. And also, I would like to thank all the panelists for giving us their valuable time for their busy schedule and inspiring us with their valuable words. As part of the conclave, we had organized pre-conclave competition, which are huge success. There were more than 5,500 registrations from reputed educational institutions spanning across the country. The winner of the finance quiz are Pratyush Goel from IIM Bangalore and runners-up D. Dheeraj from Symbiosis Center for Management and Human Resource Development, Pune. Congratulations to all the winners. The winner of the Finnova 2021 Business Idea Contest are first, Alistair S.H. Topo from IIM Indore. Congratulations to all the winners. Before we move forward, let's sit back and enjoy the conclave video, The Voice of Student, made by the school's media club in association with Finance Club.
Like to thank the entire student body, the college for organizing this fest and the finance quiz. It was a really great experience for me.
I would like to thank the organizers from KIIT School of Management for conducting such a seamless process, and I'm also excited to attend the National Conclave to be organized by them later.
So what is resilience? We have traveled through time in economies at large From the very top to the bottom, the downward flow of cash in different sectors helps stabilize the working class people by providing them adequate liquidity, which changes the shape of the graphs. Hence, the ability to withstand any downturn with the help of cash flow in the market is resilience. Come, join with us in this journey. Let's try to address the larger issues together with our idea of resilience.
Hope you all like it, guys. We request the participant to kindly stay logged in. We will begin the inaugural ceremony soon.
Thank you.
Good morning, ladies and gentlemen. I, Riddhi Goswami,
And I, Huma Jamal.
welcome all esteemed guests, distinguished speakers, corporate delegates, respected faculty members, and dear friends to the 12th National Finance Conclave of KIIT School of Management on the theme Resilience in Economic and Financial Systems, Lessons from Disruptive Changes. I request the dignitaries to inaugurate the conclave by lighting the inaugural lamp.
Today, we're honored to have with us an assembly of business leaders, academicians, and students for the 12th National Finance Conclave. KIIT, deemed to be university, India's first 5-star rated university in QS ratings of 2021, is amongst the top 10 private institutions in India to have received the Institution of Eminence status by the Ministry of HRD, Government of India. It has been ranked number 1 among self-financing institutions of the country in the Atal ranking of institution on innovation achievements 2020. Excelling not only in terms of education, but also in sports and extracurriculars. 3 students from the university proudly represented India at the Tokyo Olympics 2020.
To welcome the guests and to set the context of the conclave, we have Professor Dr. S.N. Mishra, Dean, KIIT School of Management. He was an officer in the Indian Defence Account Service, where he served as the Director of Finance with DRDO. He did his MA in Applied Economics and has a PhD in Economics. Post-retirement, he teaches economics and contributes handsomely to prestigious research journals. Sir, kindly introduce the conclave to the audience.
Good morning, friends. On behalf of Professor Achyuta Samanta, founder of KIIT and KSU University, all the faculty members, staff members of School of Management, and Professor Saroj Mahapatra, Director, School of Management, I welcome all of you, including about 241 participants who are attending this very prestigious National Conclave on Finance. Before I set the context for the conclave, let me read out a message which Professor Samanta has sent for this conclave. He is unfortunately away in Kalahandi along with the Honorable Chief Minister. He had asked me specifically to read out this message. Here is the message. The KIIT School of Management holds national conclaves every year in the areas of HR, business analytics, marketing, and finance. These events attract participation from eminent corporate leaders, academicians, and students from across the country. The 12th National Finance Conclave that is being held on the 20th of November at KSOM has a distinguished panel of speakers to deliberate on the topic Resilience in Economic and Financial Systems, Lessons from Disruptive Changes. The COVID-19 pandemic disrupted economic activities across the globe, and India was no exception. Under the direction of the Honorable Prime Minister, the government took a number of historic initiatives through the Atmanirbhar Bharat package to address the problems of the affected segments of the society. The economy is witnessing a sharp rebound in economic activities and is expected to grow at 9 to 10% during the current financial year. Technology was a great enabler of work from home and online education, and thus in limiting the adverse effects of the pandemic. As the founder of the university and the Kalinga Institute of Social Sciences, I feel a great sense of achievement that all our finance education institutions have moved seamlessly to an online mode to explain and understand the economy's inbuilt resilience to all kinds of resilience. Professor Achyuta Samanta. Friends, we have just heard the first panel, which had 5 very distinguished persons from the finance sector. Mr. Amitabh Mahanti from MDCO JM Asset Management, Dr. Tirthankar Patnaik, Chief Economist from NSE, who coordinated the discussion beautifully, Mr. Nikhil Soni, Senior Vice President from Mahindra & Mahindra, and Vivek Kumar, Economist from Quant Economic Research. We will have the second panel after the inaugural session is over. And we have the good fortune to have with us Dr. Ajit Ranade, Chief Economist and Executive Group President of Aditya Birla Group. More importantly, Dr. Ranade is an important opinion maker and makes very, very perceptive analysis on the macroeconomic and finance concerns that the country is presently facing. Let me, friends, spend a couple of minutes on some of the important trends of this pandemic, the financial and economic disruptions that we are witnessing, and hopefully they are all ebbing away. Now, friends, fiscal stimulus, one of the major fallouts of this particular pandemic has been the lesson that fiscal stimulus and a proactive government really matter. As you all know that during the Great Depression of the 30s, it was John Maynard Keynes who had very famously said, boom and not the slump is the right time for austerity. This was a very ironical statement, but very strangely, the profligacy during the 30s had really turned around the globe. Very interestingly, history repeated itself in 2008 when the global economic crisis happened, and economists like Paul Krugman, the Nobel laureate, very rightly mentioned that it is basically through a fiscal stimulus and a proactive government that the economy can come out of the morass of economic depression. The market forces certainly cannot take a country out of economic gloom. During the present pandemic, which is almost 2 years old, the world has witnessed that almost every country has put in huge amount of money into the system, varying from 11.5% of the GDP by USA, 7.5% by Japan, and India even has put in about 5% of its GDP. And this has also made very, very significant impact, particularly in India, where we find that increased allocation to Manrega has been very, very helpful in creating employment, particularly for the unskilled workers and the migrant workers. Support to the MSME has been also spectacular. So the government, in nutshell, has been very, very proactive during this pandemic period. And we also witness how both the organized and the unorganized sectors are coming up. In a wonderful edit recently, Sanjeev Sanyal, who is the principal economic advisor to Government of India, has mentioned that one of the lessons that the world has learned that helicopter money doesn't help. He said that cash transfer really doesn't help. What really help would be capital expenditure, capex rather than helicopter money, which is going to turn around the economy. There have been wonderful analysis recently by the State Bank of India. Dr. S.K. Ghosh, who is the chief economist, has brought out how there is a transformational change in India as against the unorganized sector, which accounts for about 50% of the GDP from 2011 to 2017. As you know, in India, informal sector is around 90% of our population. So it has come down to about 20% in 2021. This is a very, very significant finding. He has also mentioned how digitization has significantly increased. About 36.6 lakh jobs have been formulated by August 21. And very, very importantly, that around 5.3 crore workers are part of the e-Shram portal. So digitization has happened in a very, very big way. Particularly in petrol payment for diesel and petrol, and so digitization has come to stay. But very interestingly, as I said, there is a structural transformation, so to say, in the Indian economy. The other very important thing that is happening in India is a wonderful synergy between fiscal policy and the monetary policy. This has been very, very interesting, because earlier the debate used to be whether the RBI should contain itself on credit control and not bother about growth. But happily for India, there is a wonderful amalgam between growth and credit creations. Some of the speakers in the first panel mentioned that the present stimulus may lead to inflation. Now, this is something very interesting that, this is a debate worldwide, whether you can find optimality between three variables, which are fiscal stimulus, growth, and inflation. And unfortunately, it's very, very difficult to optimize all the three. But if you really take stock of what India has achieved, I think we have been able to contain inflation, though there have been occasional spurts in retail inflation. But in general, in an overall context, India has really done extremely, extremely well. So therefore, friends, at the end, let me mention that what really matters ultimately, how we fuse the animal spirits of the entrepreneur and how there is a political will and empathy to deal with a serious problem. And most importantly, it is the indomitable resilience of the ordinary Indians, which is going to turn around the economy. So it's just not a job of a government, it is a job of all of us. And I think India has shown remarkable resilience and in achieving most of this. And we are very fortunate to have wonderful practitioners, unlike people like me who are armchair economists, who are going to discuss with you. They have already presented their wonderful views in the first session, and we hope both Dr. Ajit Ranade and the second panel, which will follow thereafter, would be concentrating on that. In passing, I'd like to mention, friends, that India also, the character of India is also changing after economic liberalization in 1991. We clearly see very huge privatization. Air India is one of the examples. Cryptocurrency, which was something which was a forbidden topic, today is being discussed. The RBI governor is saying that we must put in place a proper regulatory structure. The tape tantrums are not really affecting India as it was doing earlier. Privatization of public sector banks is happening. So India that we talked of in 1991 and the India that I see now, there is a transformational change. So as I said, every economic crisis has also its opportunity. Digitization, privatization are some of the wonderful manifestations which have come out of this economic crisis which we are facing. So thank you very much, friends, for your patient hearing. And it's a wonderful thing that the KIIT School of Management and its faculty members have organized and this wonderful finance conclave to deliberate on some of the most important themes which are underway. I wish it all success, and on behalf of the director, again, I thank you. I welcome all of you to this wonderful conclave. Thank you very much.
Thank you, sir. We are honored to have with us Dr. Ajit Ranade, Group Executive President and Chief Economist, Aditya Birla Group, as the keynote speaker of the conclave. Dr. Ranade is a member of apex committees of industry chambers, such as CII and FICCI. He is a co-author of the recently published book, Rising to the China Challenge 2021. He writes regularly in the business papers on economic issues. He is also a co-founder and trustee of Association for Democratic Reforms, a citizens watchdog organization engaged on electoral and political reforms. Dr. Ranade is an engineer, a management graduate, and received his PhD in economics from Brown University, USA. He received the Distinguished Alumnus Award from IIT Bombay in 2009 and Scholar of the Year Award from Wardia Trust in 2010. He's one of the top professionals in the area of finance. Sir, we request you to address the gathering.
Thank you. Thank you for the very kind introduction, Riddhi. Good morning to all of you, and congratulations on the conclave. I thank KIIT School of Management, the director, especially Dean Professor S.N. Mishra, who is also a friend, and his colleagues to invite me today to be with you and share my thoughts with you. And I congratulate you for various achievements of the school, which I've been following. I was fortunate actually to visit KSOM, I think about 5 years ago, and was very happy and impressed to see the facilities and the students. Of course, This was a time before the pandemic, so it was a very different time, very vibrant. And I hope all of you are keeping safe, and we will get back to the vibrant campus feeling very soon. So today the topic is on the financial sector. Riddhi, you can hear me? The sound volume is okay? You can.
Yes, sir, you're perfectly audible.
Thank you. Thank you. So today the topic is on the financial sector, and I want to share some thoughts, and possibly towards the end, if there is some time, it would be good if we can have some interaction briefly. So to begin with, the financial sector is basically an intermediate sector. So the financial sector, which typically in our minds consists of banking, the banking sector, the capital markets, which is the stock market, the bond markets, and also the insurance sector, which is life insurance, non-life insurance, health insurance. So together we call it the financial sector. But what does the financial sector do? Well, it connects two major parts of the economy. See, economic growth and economic development is increase in national income, increase in GDP, increase in employment, increase in jobs for young people like you. The GDP increases because we keep investing, as I think Professor Misra just mentioned, investment. So when you build new businesses, new factories, when you expand in new highways, airports, this is all investment. Of course, GDP also is, increases when you have consumption spending. So investment requires substantial funding. Typically, if you want to build a bridge, the bridge will last for 50 years or even longer, but it requires substantial investment today. If you want to build a solar energy plant, solar energy, which is going to give you almost free electricity because of because solar source, you need to do the capex, as Professor Mishra said, capital expenditure today, and that requires substantial funding. And industrialists, entrepreneurs, business people, they do that. But where does that funding come from? Some of it comes from their own funds, which we call equity, but a large part of it, the bulk of it, comes to the financial sector, which is basically in India, in the Indian context, we are a banking dominated sector. So it comes from banking. Now, where do the banks get the money from? The banks get the money from people like you and me who put our earnings or our income, we do some savings, right? So the bank depositors are the source of funding, and the industrialists, entrepreneurs, business people are the user of this savings. So what I'm trying to say, and the same thing, the same principle applies for the stock market also. The investors the savers, they take their savings and some of the money goes into the stock market. And that money in turn is used by the companies for future expansion. And the same thing is true for insurance. We buy insurance policies to protect us from risks, or we buy life insurance. But that money which sits with insurance companies, and one of the largest, as you know, life insurance company in the country is LIC. I think that the total amount of investable funds available with LIC today is something like 40 lakh crores, 40 trillion rupees, or maybe 45 trillion rupees. That's the funding available for investors, business people, industrialists, entrepreneurs. So to begin with, my short point is that the financial sector just intermediates or connects savers to investors. I'm using the word investors in the economic sense of the word and not like stock market investors or like speculators. Investment spending, the spending which goes on new factories, new infrastructure. In economics, the word used is investment spending or investors. So connecting savers to investors is the primary role of the financial sector. Okay, so that's the first point. So we are examining how has the financial sector developed or how is it evolving. Now, there has been a thinking, going back to Schumpeter, a well-known economist back in the early 1900s, who believed, the thinking then was that when the economy grows, the financial sector develops. Okay. So as the economic growth happens, as people's income rises, as industrial production rises, the financial sector will automatically evolve. The products will become more sophisticated, the services will become more. So this was the thinking for quite some time, by the way, that the financial sector, there's a British economist, a friend of India, and I guess one of the probably the most prominent woman economist of the past century. Her name was Joan Robinson. She said, where enterprise goes, finance follows, or enterprise leads, finance follows. What she meant is entrepreneurs, enterprising people, investment, business people, they start expanding activity, and automatically financiers come and want to finance them. So if you are a startup, in the modern language, if you are a startup and you come with some great ideas, then bankers will rush to you. The funds will follow. Now, this was the thinking which was earlier in the, as I said, 1900s, 1960s also, maybe early 1970s. But that started changing. Ulta, it became ulta. That the thinking said, no, the economic development first, financial sector next. No, it is the other way. That financial sector should deepen first, should develop first, and then that helps economic development. That helps economic growth. So if you make the financial sector more sophisticated, for example, before 1994, we did not have an electronic stock exchange. Now we take it for granted. We did not have electronic banking. We did not have internet banking. We did not have digital banking. So all these developments in the financial sector, or fancy financial products like derivatives or credit default swaps. These are all, of course, technical concepts, but we didn't have that earlier. So the thinking from the 1980s was that if you have a fancy, sophisticated financial sector, then that in turn will cause economy to grow well. Okay, and actually the evidence started mounting for that in the 1990s. It became more and more accepted that the earlier thinking of 1960s, that first the economy has to expand, then only you should develop your financial sector. Now the thinking is the other way, that you need to develop your financial sector. You need to make it more sophisticated, and it will help economic growth. Remember, the role of finance is simply to connect savers to investors and help economy grow. That way, the financial sector is supposed to be a handmaiden to the larger cause of economic growth. But now, since 1990s, and I must say there is an influential paper by our own former governor Raghuram Rajan and his co-author Luigi Zingales. I think the paper is from I think about 20 years ago. That they studied industrial development, industrial sectors across the world, and they showed that in many countries, industrial sectors were able to expand much more or make more technological advance when the financial sector was larger. So they also, their research also supported the view that finance leads, industry follows. Okay. Now, with that background, we jump forward to 2008. So I'm just giving a little bit of historic background, just to tell you where we are in the journey of the evolution of financial sector. We jump to 2008, and you know what happened in 2008. And I mean, I'm sure all of you are very young people, but you've read up on the great financial crisis of 2008. That in September 2008, one of the most respected gold-plated investment bank called Lehman Bank or Lehman Brothers, it went bankrupt just overnight, just crashed. It's called the Lehman crash. There was a risk that half of Wall Street would just crash. So AIG, the world's leading insurance company, then Bear Stearns, even other big companies, they were on the brink of default. In fact, Lehman Brothers doesn't exist anymore. 200-year-old institution is gone, kaput. So because of that, on September 15th, I think in 2008, the US Congress, what we call in our country the Lok Sabha or Parliament, in the US it's called the Congress. The US Congress had an emergency meeting and they approved an emergency fiscal bailout. It's called the TARP, Troubled Asset Research Program, or what we would call, in the pandemic time, we are in now 2021, we had a Atmanirbhar Bharat package announced by the Honorable Prime Minister last year in May. But basically this in 2008 was something similar, emergency rescue package. $700 billion was approved by their parliament or their Congress without even much discussion or debate. And that money was then used to rescue the remaining. So Lehman was gone, other rescue were done, and some emergency funding was infused into the financial sector. And subsequently, of course, we have seen the evolution. We can talk about that separately. Now, what had happened is, till 2008, what had happened is that the financial sector had grown 6 times faster than the US economy. Economic growth, let's say if economic growth is 2%, the financial sector had grown at 12 or 13%. At one time, just before 2008 crash, 50% of all the entire profits of the corporate sector. The corporate sector includes manufacturing companies like GM, Ford, or oil companies, and the financial companies. If you take the entire corporate profits in the US, 50% was going to the financial sector, to banks, investment banking, and so on. In fact, if you had, forget about just having an MBA, I'm sure all of you are MBA students, but if you had a degree in mathematics, people who had PhD in mathematics, PhD in physics, engineering PhD, they were all being absorbed and sucked by Wall Street. I think that's happening even today after 13 years. So this was having a great impact on society, not just the economy, but society. The top talent was just going to Wall Street. If you ask a young person, what do you want to be? Investment banker. If you ask the person, do you know what is investment banking? How is it different from commercial banking? Half the people can't tell the difference. But I'm just saying that the financial sector was growing 6 times faster. And then we had the crash. So after 2008, again, there's been a rethinking. Is it that should the financial sector grow at a pace which is somewhat more reasonable and moderated compared to the economy? Is the economy more important or the financial sector more important? So we're back to that kind of thinking. And of course, 13 years later or 12 years later, we had another big crisis, which is the pandemic, right? That is not caused by, of course, it's not caused by the failure of a financial sector organization or a bank, but that is suddenly, economic activity has stopped. And but look at what has happened during this time. The stock market has grown by, I don't know, in last 12 months in India, at least at some 50% perhaps. The stock market in the US is such that the top 5 companies in the stock market there have more value. The valuation is more than the bottom 282 companies. This is in the S&P 500. Like in India, we have the Sensex, which is an index of 30 stocks. In the US, the most popular index used is not the Dow Jones index, which is 30, which is also 30 stocks, but the S&P 500. The stock market, has zoomed so much that the value of the top 5 companies is more than the bottom 282 companies, and it's growing every day. I'm sure you read about Tesla, Elon Musk, or Amazon, or Apple. So have we learned the lessons of the financial sector? I mean, let me spend the next 3-4 minutes in explaining how what's happening to the stock market. I mean, this year India has been fortunate to have something like 33 unicorns, that is companies with a valuation of more than $1 billion or almost 8,000 crores. And then some of them are getting listed, like companies like Zomato or Nykaa, and a couple of days back, Paytm. So what happens is that if an IPO is coming up, initial public offering, the stock is going to be listed. So if you have, let's say, if you're a high net worth individual and you have, let's say, 1 lakh rupees with you, okay, you go to the bank and you tell them, I need 99 lakhs from you. Why? I need IPO financing. So together, 99 plus 1, I will invest 100 lakh rupees in this Zomato. There is a wonderful company called Zomato, which is coming up for listing. I want to invest in this IPO. I have 1 lakh rupees savings, but I want to invest 100 lakhs because I'm told that there's so much oversubscription. And indeed, the Zomato was raising something like 9,000 crores or 8,000 crores of IPO. The actual money which was invested in the IPO was 3.8 trillion, 3.8 lakh crores. So how did that happen? Because financing. We are back, we're talking about the financial sector. So because of the oversubscription, almost 40%. So for every 1 rupee of IPO, 40 rupees was being invested, bidding was going on. So everybody got an allocation of barely 2.5%. So I go to the bank and I invest 100 lakh rupees, 100 lakh invest in the IPO, but I get only 2.5 lakh worth of 2.5 lakh worth of shares. So I repay the remaining money. I repay to the bank. All this happens in 15 days, by the way. Then I pay interest for 15 days, which is only 6 or 7% because interest rates are low right now. So net of after paying interest, after returning the money to the bank, how much money is left with me? I got, remember, 2.5 lakh worth of shares, and half a lakh is all my expenses for 50. So I'm left with 2 lakhs. So in 15 days, I brought 1 lakh rupees of my funds. After 15 days, I have 2 lakh rupees. How did that happen? Financial sector, financing. So this is called IPO financing, and it's called leveraging. And this has been going on, so in fact, the RBI is now worried. So this can have implications. So of course, my talk is not about Zomato. I mean, I'm just using it as an example. But the Reserve Bank of India, which is the regulator, has got worried about this. And therefore, now they have put a cap on how much you can leverage. A person with 1 lakh rupees cannot come to the bank and ask for 99 lakh rupees of loans. You know why the banks are willing to give you a loan? Because it is fully collateralized. It is loan against shares. So the 100 lakhs that you invest is all against Zomato shares. And if you don't repay, those shares remain with the bank. They'll just sell it off. In fact, by the way, Zomato made on debut, the stock went up by 60%. The Nykaa stock went up by 80% on the first day itself. So the bank actually makes a profit. The bank gives you 99 lakh or 100 lakh rupees. On the first day itself, the stock is worth 160 lakhs. So the bank will make a profit. So bank is happy to give you a loan. The same thing was going on in the US before 2008. They were called ninja loans, NINJA. No income, no asset, no job. So people were being given loans for housing when they had no loan, no income, no asset. And the bank was happy to give you a loan against your house, 100%. And if you miss your EMI in the first month, second month, third month, they will repossess your house and they will sell the house in the market. And by then the housing prices have gone up. So the bank actually makes a profit. And in the US, unlike in India, defaulting on your housing loan is not considered to be a matter of stigma. So this housing loan, the 2008 crisis was basically a mortgage crisis. It started with the crash of housing prices. From 2003 onwards, housing prices was just going up and up and up and up. Just like what the stock market is doing now, it was a question of the housing bubble. So it was kept on going. So the banks were happy to participate. Banks were giving loans left and right. And the loans were getting profitable because they were loan against property and the property prices were going up. The people were happily taking the loans, but they didn't mind defaulting because they had no income. In those 3 months, they enjoyed the property. It went back to the bank, repossession, default, sale in the open auction, open market, make a profit, fresh loans. This continued for many years, and one day the party stopped. One day the bubble burst. So now the lesson for us is that Reserve Bank of India has now clamped down, has now said that no more IPO financing like this. You should have moderate leverage. But if you moderate leverage, then you're strangling the neck of financial sector. The financial sector guy says, no, we are doing innovative things. Now we are introducing crypto. I don't know how many of you are investing in cryptocurrencies. So you can invest as small amount as 1,000 or 2,000 rupees. Crypto is the new asset. So this is the struggle that keeps on going between innovation, sophistication, new products and services, and the caution from the regulator of being not leading to bubble-like situation, not leading. And just a few days, I mean, we've seen that the Paytm IPO, the first time we have seen that the IPO actually on the very first day, instead of the prices going up, it went down by 27%, which was a loss of investor wealth of 38,000 crores. In just one day, 38,000 crores worth of wealth was destroyed. And now there is concern. I'm told that even the stock market regulator, like Reserve Bank of India is a regulator for banks. The stock market regulator is SEBI, Securities and Exchange Board of India. They are now investigating whether investment bankers who are responsible for the issue of the IPO, whether they were misleading retail investors. Because after listening to all the great publicity and the great write-up about Paytm, a lot of retail investors must have put money. Like I said, I have 1 lakh rupees of my savings, hard-earned savings. Instead of putting in a bank, let me put it in this IPO. And at the end of 24 hours, after investing after 15 days, I find my 1 lakh rupee has come down to 67. It's down 27%. It's down to 73,000. I've lost 27,000 rupees. So, for me, that is big money, right? Small investors. So retail investors. So who is to be blamed? You can't, this is the market forces. This is why the financial sector needs regulation. So let me just retrace back. I began by saying that in the modern times, people like Schumpeter, Joan Robinson, and other economists believed that the economy has to grow, and then the financial sector development happens, the deepening happens. But in the 1980s, especially in the 1990s, many researchers said, no, the financial sector needs to develop and automatically economic growth will happen. And that thinking was popular until we had the 2008 crisis. So now it's like a pendulum, there's debate on both sides. There are people who believe that the financial sector needs further developing. See, in India's case, India's savings rate is roughly 30% of GDP. Our GDP is about $3 trillion today, or after pandemic, maybe about 200 trillion rupees, 200 lakh crore rupees. 30% of that, so 30% of 3 trillion is $900 billion, or 30% of 200 trillion rupees is 60 trillion rupees, 60 lakh crores. So that is our annual savings. That's the amount of potential funds that can go into building new factories, new infrastructure, new schools, new economic activity. But unfortunately for us, half of it goes into non-financial sector. That has been the bane of India. It goes into buying real estate or gold. So all that happens is the real estate prices go up. That's not productive. When I sell a piece of real estate to you, GDP does not grow up. GDP does not go just simply by change of hands of assets. If I buy a gold coin, that doesn't increase GDP. So half of our annual savings, national savings, goes into the non-financial sector. The remaining half goes into the financial sector. Actually, that trend has actually gotten worse. I'm told it's gone down to not 50%, but 45, 47%. So more than half is in non-financial sector. So we as a country want our financial sector to deepen. We want it to deepen. We want more and more savings should go into the financial sector. People should put their money in mutual funds, in banks, in fixed deposits, in insurance, in pensions funds. They should not just lock up their money in buying a piece of real estate. okay, which will go. But such is the state of development of our country that it's going to take some time. Other countries, developed countries, the ratio is much more, maybe 80, 90, 95% goes into savings. So a typical household in the US, their wealth will lie in all financial assets. So that's the direction we want to go. But we want to temper this journey in a way where we don't let the financial sector go out of control and land up in bubble-like phenomenon, what happened in 2008 in the US. And incidentally, 2008 was not the unique bubble bursting. It was very big. But we have had a series of such financial shocks. There was a I don't know if you read, there was a East Asian crisis, which was in 1997. There was the Argentino peso crisis. It was a currency crisis, not a banking crisis. But we've had episodes of banking crisis. If you look at our own history of last say 7-8 years, the non-performing asset ratio has been rising since it went up all the way up to 10%, 10-11%. And then during the pandemic year, the Reserve Bank of India gave some relief and gave some moratorium, saying that we will not, loans need not be repaid for 12 months. We can have a moratorium at least on the EMIs. And therefore, the NPA ratio has now somewhat improved. But again, we need to be careful. So the NPA ratio going up means the bad loans are increasing. Now, thankfully, we have some things now in place which will address this problem. So we had the creation of the bad bank, or what is called the National Asset Reconstruction Limited, government-backed company, which was set up, which will take all the bad loans from the commercial banking sector, and then so that the banking balance sheets are cleaned up, and therefore they can make fresh loans, and the NPA ratio will come down. So this is a new development. That's the banking reforms, and it was actually pending for many years. And hopefully, going ahead as the economy starts recovering, we will see more sort of healthy growth in the financial sector. That is the bank balance sheets, loans, healthy loans, and also the other aspects of the financial sector. So what I'd like to do now is give you one or two other examples, because the topic also talks about disruptive changes. See, one of the disruptive changes has been the growth of digital banking, the growth of say UPI. I don't know how many of you use Google Pay or Phone Pay. I'll be surprised if I'll be surprised even if a single person has not used Google Pay or Phone Pay among the younger people. But it's a disruptive change, right? What happened is a few years ago, the Reserve Bank of India gave licenses to new class of banks, new category of banks called payment banks. See, the Reserve Bank of India is the regulator for and licensor of banking. So there are the usual old style commercial banks, but now about 4 or 5 years ago, they gave a new set of licenses to payment banks. I'm sure you heard of Airtel Payment Bank, or Paytm also has a payment banking license. So what does a payment bank do? The payment bank allows you to make payments, right? So if a person X wants to transfer some money to Y, the payment bank gives you using your net banking, electronic banking, or mobile. But the conditions that were used, that were imposed on payment banks were they were not allowed to they were not allowed to make any loan. See, what is the fundamental business of a bank? The fundamental business of a bank is to accept deposits from savers like you and me, and then make loans to industry and business and entrepreneurs. And they make, by charging interest on the loan, they make a profit. Out of that profit, they pay you interest on your fixed deposit. It's very low, I know. I mean, compared to, in fact, nowadays the FD rates are very low. And that's how banks make a profit. That's how they're able to survive and sustain. That's how they do innovation. But payment banks were not allowed to make any profit. That was the rule. That was the condition of the license. and they could accept 1 lakh rupee deposits, I think. And they, out of that, all the entire deposits were supposed to be invested only in government securities. So no loan is allowed. So what happened basically is that the business model of a payment bank was that they could charge a fee for transferring, for making payments from when a person X makes a payment to person Y, they can charge a fee of, let's say, 10 paisa or 50 paisa for 100 rupees or 50 paisa for 1000 rupees. And that's the way they were supposed to survive. Guess what happened? Within a few years of the license being given, we had the phenomenon of Google Pay or Phone Pay or UPI based apps. What do? It's free. Google Pay allows you to transfer payment even as small as 5 rupees or 10 rupee payment for free. You can pay your newspaper wala, you can pay your istri wala, the person who irons your clothes, you can pay for vegetables, you can pay for so many things. When a person, you go together to the canteen, cafeteria, you buy two, say, I don't know, two sandwiches, and your friend pays off the bill. He says, okay, I'll pay you 100 rupee bill, I'll pay you 50 rupees, I'll Google pay you. So the payment system innovation is such disruptive change that it's free. So now the payment banks are in trouble because the only source of income they could make is by charging a fee. And that fee has gone down to zero. So that's an example of disruptive change. So what has happened is that, of course, UPI-based transactions in the country, in the economy have zoomed. It was last year, it was about 1 billion transactions a month. We are already at, then it went to 2 billion. And in October, I'm told there were 4 billion transactions. So number of transactions on UPI-based apps like Google Pay or Phone Pay and others have zoomed like anything. So at the same time, the cash in circulation in the economy is also rising. So today, the economy has something like 29 lakh crores of cash circulating. And it is 57% more than pre-demonetization. But UPI-based payment systems are also zooming. So what has happened is the other payment systems which came in, like the payment banks or prepaid wallets. I don't know if you ever used wallets like Ola Pay or I don't know if Zomato Pay, something. These are all wallets. So you could store some money and or Amazon Pay or something, and from that wallet you make a payment. But those wallets are now going. People are preferring to do Google Pay, which is directly from your bank account. You don't need to have a wallet. So actually, the increase in UPI-based transaction is taking the market share away from prepaid wallets. It has not been able to reduce the cash in circulation. We think we are going towards a cashless society. I think that will take some time, obviously, but hopefully it'll, if not cashless, we will reach towards a less cash society. But certainly, so this is an example where the disruptive change of payment systems using UPI has really shaken up now the payment bank license. Now the worry is that these banks which had got payment bank licenses from RBI, will they survive or not? In fact, 10 banking licenses were given. 5 companies surrendered back. They said we cannot do any profit based on these RBI conditions. RBI itself is looking at whether they should relax the conditions of the license so that the banks can at least survive. So they can at least survive the competition against UPI-based transactions. Incidentally, UPI is also a monopoly. Unified Payment Interface, UPI-based clearing, UPI transactions, the backbone is handled by one company called National Payment Corporation of India, NPCI, and it's a monopoly. So now the RBI is saying maybe we should have one more player so that there's competition. Just like before 1994, we had only one exchange in the country called Bombay Stock Exchange. It was a monopoly. Then we introduced a new exchange called National Stock Exchange, NSE. And people said, how can you have 2 stock exchanges in the same country? And guess what? Many years later, now we have one more, 2 or 3 others. So stocks can be traded in other stock exchanges also. Similarly, in UPI, the UPI monopoly of NPCI perhaps will go after a new corporation is also allowed to do UPI-based clearing, UPI type of clearing. So these are, there are disruptions in payment. That's an example of disruption in payment systems. I'll give you another disruption which is coming from fintech companies. This is on lending. Remember, the fundamental job of a bank, the fundamental business of a bank is to make loans. When you make profit on the loan, you make sure the loan is recovered, it doesn't go bad. And from the profit, you pay your depositors. And then, of course, you do innovation and you pay salaries and so on. Now, typically, the loan appraisal was done on the basis of, you make a loan application and then you provide some collateral. So lending, conventional lending is to be based on collateralized against collaterals or your income statement or some income projection. You show that you have income. All that is changing now. In the fintech world, now they are able to give you a loan based on your digital trail. They will say, show me your electricity bills for last 12 months. Or they will not even share. They'll say, just share your Facebook account. So we will know on which day you are watching a movie or I don't know, they're using AI tools, artificial intelligence tools. So they actually, by trawling, T-R-A-W-L-I-N-G, trawling, not trolling, trawling, T-R-A-W-L-I-N-G, by trawling social media, your Twitter profile, your Facebook account, or by accessing your digital trail, by looking at your CIBIL score, they're able to give you a loan without even collateral. And that's a disruption. It is already a big industry in China, I think other countries, and India, it's also coming. In fact, there are many of the startups, the exciting thing about startups, and many startups are in fintech, is because they are using all this digital modes to have innovative ways of doing loan appraisals and instant loans. You're promised a loan within 1 day. Again, using digital. This is another second example of disruption is happening, is going to come in lending. There are now banks, there is a bank in Korea, I think, which is purely digital. They have no branches. It is pure digital bank. There is no branch. You can't go and walk to a branch. There is very little paperwork. Everything is digital. There are now, the distinction between retail bank and a grocery store is getting blurred. When you go to a grocery store in a large mall, if you're buying, say, from Reliance Fresh or More or D-Mart, you will see there are these kiosks, ATMs, or you will have a card issued by the grocery store, and you can use that to make payments. So you're wondering, am I in a bank or in a grocery store? And the converse is also true. There used to be bank branches where they started having a coffee shop. So you think, am I in a bank branch or am I in a coffee? Because they want you to browse through other services, mutual funds, insurance, wealth management, wealth banking. So the evolution in banking is happening, and technology is really disrupting. But I just want to just make a few concluding remarks on this, that because I have not even gone into crypto, the new asset classes of investing in crypto. The exciting and perhaps scary thing about crypto is that the crypto as a currency actually does not depend on any central monetary authority. So it does not require a central bank to issue that currency. So people can buy and sell cryptos, can invest, can in fact use it for payments, and there is no central authority responsible for creating money supply. See, the whole purpose and foundation of monetary policy is there is a central bank which creates money supply. If there is a lot of supply, that leads to inflation. If it's contraction of supply, it reduces inflation, and they can control interest rates. The crypto world just completely, undermines this. That's why there is discomfort. Some countries are thinking of banning crypto. In India also, there's a lot of debate. So far, it is not illegal. And if you look at some of the front page newspaper ads in the last couple of months, they're all crypto advertisements. I don't know if you've watched IPL, the cricket matches. Who are the main sponsors? So the crypto world is also exploding in India, and policymakers are watching, parliament people are watching, so that's the new disruptive trend in the financial sector. So let me, as I said, my concluding remarks is the following. We have to remember, number one, that the financial sector is an intermediary. It plays a role of connecting savings to investors. Economic growth happens when the aggregate pool of savings is deployed into productive investments in the country. Second, whether finance causes growth or growth causes finance is an open debate. It was believed that it is economic growth which comes first and the financial sector develops and becomes more sophisticated. But the contrary view also has been around. And after the 2008 crisis, it's still an open debate. It needs to be regulated, and we need to avoid bubble kind of phenomenon. Number three, various conventional models are getting disrupted, whether it's banking or stock markets or investments, or I would say even insurance. It's getting disrupted all the time. And the main reason for disruption is digital. So we need to understand this phenomenon of increasing digital penetration in every aspect of the economy, including the financial sector. The last point I want to conclude also is to remind you that financial sector is an exciting field, obviously, and students of management, I know that apart from consulting and startups, one of your favorite job market is to be in a financial sector company, preferably fintech or investment banking. But we also need to be aware that there is a phenomenon called increasing inequality, whether it in terms of access to financial services or access to stock market wealth inequality, or digital inequality. As we become very savvy with using digital tools, I'm quite comfortable making Google Pay payments. I'm quite comfortable switching my funds from mutual fund, debt fund to equity fund back and forth. I'm quite comfortable buying crypto, but it's a tiny fraction. We need to know how to bridge this inequality, widening inequality, income, wealth, access, and of course financial literacy. So as leaders of society, future leaders of society, I think you have a responsibility not only to become successful, of course, and help your friends, family, and your career, but also hopefully participate in the policy around how to keep the inequality in check. I'm not saying we can never go to zero inequality, and that's not even desirable probably, but how to keep it in check so that it doesn't disrupt national life and cause detrimental consequence to our society. So I thank you again for inviting me. I hope some of these thoughts have been useful to you, and I congratulate you on the conclave. And I'm happy to, if there are any few questions and time left for questions, I'm happy to take that. Thank you.
Thank you, sir. It was fascinating to listen to you on the subject. Students, by their very nature, are very inquisitive, and they have a few questions. So with your kind permission, sir, can we take a few of them?
Of course, yeah.
I request the students to raise their hands, and as I call out your names, you can unmute yourself and pose your questions to our distinguished speakers.
Yeah, Shreya.
Yeah, Shreya.
Go ahead, Shreya.
Yes, sir. Good morning, sir.
Good morning.
So, my question is that as you elaborated about the fintech and the digitization of the financial services, so what are the implications in this current market structure, and what are the reforms in the policy for the policymakers?
No, fintech is the marriage of financial services with technology, and mainly the technology is digital. So from the policymakers, they just they want to reduce. The policymakers want to adopt a sandbox approach. They are allowing fintech to, for example, KYC norms. Know your customer. Now, a bank is not allowed to open a deposit account or even make a loan unless you fulfill your KYC. And in the earlier days, KYC, I don't know, you will probably, I don't know if you know this, but to open a bank account, the bank officer or somebody from the bank had to come to your residence or ask your neighbor, does she live here? Long ago, I mean, I'm talking about, but we have come to a point where you have instant KYC thanks to Aadhaar. But and even that, some people are saying, can we fast track? So the answer to your question is that what are the policies? So there's always policy which tries to make life easy for financial services companies using digital technology, but at the same time not make it so vulnerable that it can lead to abuse or some loss, fraud. So I've not in my talk talked about cybersecurity. There's a lot of hacking risks. People don't, sometimes you get OTP, it gives you only 20 seconds, it's not working, and somebody just calls you and, makes you believe I'm calling from the bank, please give me your OTP. So because of that, you have to always have a trade-off between how much to promote and how much to, be careful about the promotion. So I'll just call out the names. We'll go to Tanu Priya. You're on mute, Tanu.
Yes, sir. Sir, as before payment disruption in payment, you mentioned a thing that people should invest more rather than more options rather than real estate. So one option you mentioned is fixed deposit. As we have seen in past this year, that fixed deposit is not giving that much benefit to the peoples. Rather, people are incurring losses. So what will be the future of investing in fixed deposits? Please shed light.
Thanks, Tanupriya. I did not say should or should not. I'm not saying people should not invest in real estate and people should. I was saying that is the evolution of our country. We are at a stage where almost 50% of our national savings, which is very precious, is going into unproductive usage like land, real estate, or gold. Ideally, as a country develops, more and more fraction of our savings should go into the financial sector, which in turn leads to productive investments in new factories and new businesses. Now, you mentioned that when a person goes to a bank and tries to put their money in a fixed deposit, you are earning only about 3 or 4% for a 6-month or a 12-month deposit. But the rate of inflation today is 6%, 7, 8%. So you're actually earning a negative return. That is one of the reasons why people are going into the stock market. They said at least the stock market is rising faster, but it is full of risks. So the question here is what to do. Now, this is not an easy question to answer because the Reserve Bank of India should not keep interest rates so low. According to me, they should take care of the interests of depositors, not young people like you who don't mind taking risks, because even if you lose money in the stock market, tomorrow you'll get a great job. What about pensioners, people who are elderly? About 200 million people in the country are above the age of, maybe 55 or something, and they cannot afford to take stock market risk. They depend on pensioners depend on fixed deposits, and they are earning a negative return. So I think it's up to the policymakers to balance the competing interest of people who put money in fixed deposits as against people. But if you raise interest rates, that IPO financing example I gave you will not work, because it works because low interest rate allows you to borrow from the bank and invest heavily in your IPO. So they will be upset. So there'll be a stock market lobby which will be against RBI saying, no, don't raise interest rates. A lot of the industry lobbies say, don't raise interest rates because it is detrimental to economic growth. So the regulator and policymakers have to compete these interests. Thank you. Let's go to Squash. You're on mute, Sparsh. I still can't hear you, Sparsh. No. I'll come back to you, Sparsh. I'll go to Ishan Rath.
Hello, sir. First of all, thank you for such a wonderful session so far. My question is related to normally the fintech platform, because everyone is very hopeful towards future of fintech. But we're considering the fact that for recent days, Paytm IPOs received a far weaker response in comparison to other recent IPOs that witnessed a bumper stock market debut. The company's IPO saw a very weak response on the first 2 days and barely it's oversubscribed for the final day. So what's your views on it?
Which company?
I'm talking about Paytm, sir.
Okay, so I am not at all an equity analyst. I have zero knowledge about how to do analysis of companies. So I just took it as an example. I'm saying that this is investing in stock market as against putting your savings in the bank. There is a difference. The bank savings is considered to be safe, but nowadays even the bank can fail. As you know what happened with Punjab and Maharashtra Cooperative Bank, or before that Yes Bank and so on. So, but banks are considered to be safer and stock market is risky. And the IPO financing game was going on. But now people who must have put heavy amount of money in Paytm, they found that on first day itself, they lost 27%. So my only illustration was that. So I really can't go into answering the question, what is Paytm is a very complex, big company, and I'm sure there's a lot written there. Thank you. Let's go to Karthik. Yeah.
Hello, sir. Thank you for the insightful speech. It was really great to hear you. I'll quickly ask my question. You mentioned about the monopoly of NPCI in the UPI segment, which RBI is taking into the cognizance. Am I audible?
Yes, yes. Yeah.
Yeah. So my question is about the monopoly. We have studied that price is usually greater than the marginal cost, and the system turns out to be exploitative for the consumers in the short as well as in the long run. So I want to understand from you, in the current context, how is NPCI, given the situation, given the condition that it's basically more or less free of cost for the consumer. So how it can turn exploitative, or what is the reason
I
for
didn't
RBI
say,
considering?
Yeah, Karthik, I did not say that NPCI was exploitative, not yet anyway. I just said
Yes,
they're
sir.
in monopoly. And one of the problems with the monopoly, as you yourself say, it could be exploitative, but that is not that is one concern. But the other concern is that a monopoly company typically stops innovating. Okay. So NPCI, for example, I would like to have, we have a lady who comes to go wash our utensils, household help. Now I pay, let's say we pay her 1,000 rupees every month as for that. So I would like to have NPCI, which can allow me to Google Pay feature, where I pay on first of every month 1,000 rupees to be paid to this Google Pay to this person for the next 12 months or next 6 months. I don't think NPCI is offering me that. Google Pay does not offer me that. So this is just one trivial example. There can be hundreds of examples where product innovation is not happening. If they had competition, the competition would have offered many products like this. I can think of so many different combinations. I would like to have in one button, I would like to make 5 payments to 5 different people. But I have to go through the blah, 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 blah. So this is what financial sector innovation is all about, innovation in products and stuff. And when you have competition, they'll compete against each other to give new and new, some ideas. Otherwise, if you're a monopoly, you will be complacent. Ek transaction hota rahega. Okay. So let's go to Ankita, please. And then maybe the last 1 or 2 questions. Go back to Sparsh. Yeah, Ankita.
Good afternoon, sir. I just want to ask you a question that, as you mentioned about that India's bane is that half of its savings goes to the non-financial sectors like gold and all. So is there any initiative taken by the financial sectors to attract its customer towards they should invest in them rather than investing in gold?
I think, Ankita, excellent question. Thank you. Now, there is one great famous gentleman called Amitabh Bachchan, right? You have heard of him? So he is a brand ambassador for a company called Kalyan Jewelers. Have you heard of Kalyan Jewelers? So I have been saying for many years, why don't we ask Mr. Amitabh Bachchan to be the brand ambassador for something called Sovereign Gold Bond, SGB. This is demat gold. This is sold by banks and through RBI. This is an instrument which is a financial sector instrument. You invest 1,000 rupees or 5,000 rupees or whatever. It is an 8-year. The gold bond is valid for 8 years. Maturity date is 8 years. You will get the current price of gold. That means market price. So it is like investing in gold. Plus, you also get the advantage of exchange rate, because if the exchange rate in India depreciates, you get that advantage. Thirdly, it is tax-free, meaning no TDS is cut. And fourthly, on top of all this, they offer you 2.5% interest. But sovereign gold bond was, we have been discussing this with the finance ministry people for many years. I remember more than 6 years ago. It was introduced only in 2018, I think, or 2019. And have you invested, Ankita, in sovereign gold bond? No, because nobody has told you, because nobody has explained the attraction of it. So this is an example where I think the financial sector also should do more to educate you to financial literacy ke liye. How, in fact, investing in sovereign gold bond is just like investing in gold, but it gives you even better return, I would say. And investing in sovereign gold bond, which is a demat account, that money will go into the India's financial sector. That is not dead. When I said half of our savings goes into financial sector, when you invest in sovereign gold bond issued by RBI, that is actually financial sector savings. But when you go and buy a jewelry from Kalyan Jeweler, I'm sorry, I have nothing against them. God bless them. But that is, just buying jewelry. So that is gold. I don't think it's as productive as building a new factory. So we'll take, I don't know, Dean Mishra, how much time we have. We'll take 2 questions, one from Sparsh and one from Akshay. We might run out of time. Yeah, Sparsh. You're on mute, Sparsh.
Can you hear me now, sir?
Yes.
Good afternoon, sir. Very good afternoon. So, sir, I just have a small question. Currently, the inflation rate is showing an increasing trend. Interest rates, while are also decreasing comparatively. Then, with real return on the investments for the banks itself are decreasing, sir. How will this trend affect the growth in the economy itself?
No. Real return for banks are not decreasing, Sparsh. The return for the bank is when bank gives out a loan, they are charging interest rates of 15%. If you're an SME person, first of all, getting a loan is difficult, but if you go and take a loan to build your new factory, that interest rate will be 15% or at least 12-13%. So as a fixed deposit, when you put your money in the bank, you are getting only 3-4%, and the bank is charging 12-13-14% for a loan. So the bank is getting a handsome return.
I was talking about the increase in NPS, sir, as you explained earlier, and how the increase in NPS.
The question is when the bank makes out a loan, they charge an interest of 14%, they get a good return. But unfortunately, some of the loans are turning bad. And unfortunately, 10 lakh crores out of 100 lakh crores, 10 lakh, so 10% of the loans have gone bad. Now, how to control bad loans, that is an old problem. Now, it used to be said that because some loans are made, there is outright fraud. You heard of this Mr. Choksi, Mehul Choksi? Have you heard of, let me not name all the other names. So those people just ran away, right? Modi, what is the name? Nirav Modi. So some cases are outright fraud. Some cases, I must say, the NPAs are because the business cycle downturn happened. If I was someone who had given invested in, let's say, a plant, a fossil fuel plant, which they say that it's going to decline with solar energy. So, today I think I read an announcement that the Reliance and Saudi Aramco deal has been called off. Maybe because, I don't know, I've not read it fully, but because the future of fossil fuels is not as bright as it used to be, because the whole world, we had this COP26 agreement that we want to phase out fossil fuel based energy and replace it with renewable energy like wind and solar. So if you invest, so that is an example where business downturn can happen. So for example, during the pandemic, all the restaurants, all the malls were shut. So any bank which has given a loan to them, that will turn an NPA. So NPA has various problems, but we have to have mechanisms where we can quickly resolve them, restructure them.
Thank you.
So maybe Akshay, we will go with the last question. Akshay. Mr. Akshay Sahu.
Yes, sir.
Yeah.
Thank you, sir. I want to ask sir, the cryptocurrency is how far it is safe, as there is no one to regulate the cryptocurrency.
So you are asking me how safe is it to invest in cryptocurrency? I have to tell Dean Professor Mishra next time to invite me as a stock market expert and crypto expert. So, because I'm not the right person to answer questions about which stock market, why is it going up or down. You need to understand how this cryptocurrency investment works. It's a blockchain based technology, and it is of course, I'm not saying it's not easy to understand, but It is worldwide. It's not just in India. JP Morgan, which is a very famous investment bank, their analysts are saying they expect the Bitcoin price to go up to $120,000 per coin. Right now, it's at 62,000. And not some time ago, it was just 30,000. There are people in India I know who have bought it when the price was only 1,000. They have made good money on it. But it's a very speculative instrument. And it's not for me to either advise or caution. I think you'll have to do your own research or go to an expert.
Okay. Thank you.
Thank you. And thank you everybody for your patience. And I wish you all the best.
With your kind permission, Dr. Ranade, I have just one question from you.
Sure, sure.
You mentioned about disruptions. Now tell me, I mean, the government is also looking at increasing privatization of the public sector banks. They are trying to make a beginning. And there are many, as you know, who are very strongly batting for going back on nationalization, privatizing the public sector banks as a very important component of financial intermediation. Do you think that the disruption that is likely to be caused would be better? Or, I mean, what's your take on this, particularly the concerns regarding, the corporates taking over the banks, the licensing arrangements, So what is your take on this? Thank you.
For economic growth, we all aspire that Indian economy grow at say 8% or 9% on a sustained basis for next 10, 15, 20 years. That economic growth is not possible unless credit also grows at 15%. That means banking credit to industry, small and medium businesses, to startups, it should increase. The credit growth should be at least 15 to 18% per year. Today, the credit growth is hardly 8 or 9% or 5%. So credit has to grow at 15, 18%. Now, for the credit to grow, the bank balance sheet has to expand, which means that the bank, not only bank deposits have to grow up, but also the banking capital. For every 100 rupee loan that a bank makes, it has to set aside 12 to 15 rupees as risk capital, which is the capital adequacy norm. So if bank balance sheet is going to increase, then the banking capital also has to increase. My estimate is that in the next few years, Indian banking will need something like 5 trillion rupees, 5 lakh crores of fresh equity infusion. Now, if it is public sector banks, if 70% of banks are public sector and owned by the government of India, this fresh equity has to come from government. But government of India is under huge fiscal stress, fiscal challenge. So where will the money come from? So if you want the banking to grow and you need fresh infusion of equity, banking equity capital, either it will come from the corporate sector, which is sitting on a large pool of risk capital, or it will come from foreign. If you allow foreigners to come and own banks, right now, foreign ownership of bank is restricted. We do not allow 100% ownership of foreigners. Of course, you have branches. So HSBC, Citibank, or Standard Chartered, all these banks have branches in India. But they don't have FDI, they don't own the bank here. So they have to incorporate here and have. So either we have to allow foreign ownership of banks completely, or we have to allow corporate ownership of banks. Or we have to ask the government of India to put 5 trillion rupees more. They are struggling. They need more money for NREGA. They need more money to pay for pensions. They need to modernize defense. With the challenges on our northern border with China, we need to have much more modern. They need to invest in infrastructure. So that is the challenge. The answer to Professor Mishra's question is, this is the challenge that the policymakers will have to figure out. If we allow corporate sector to put their capital in banking, the fear, apprehension is that the corporates will do connected lending, that they will give loans to their friends, but that was the fear, I guess, in the 1960s or 69 or 70. Today, we have a much more sophisticated system of regulation. We have much more digital, sort of 360-degree view. And I think there are adequate measures which we can put in place which we can ensure that the corporate sector does not abuse the license. In fact, if anything, we can ask the corporate, if a corporate sector sponsored bank is set up, then it should be ring fenced. No other ownership and connection should be there. Incidentally, banks like IndusInd Bank have substantial investment from Hindujas, which is an industry house. Kotak Bank used to be actually Kotak Mahindra Bank, and that is investment from Mahindra, which is an industrial house. So I could give you other examples. I'm told that Bajaj, which is another industrial house, has 6-7% investment in ICICI Bank. So it's not as if there's not enough industrial corporate sector investment in banks, but this is a policy question. I mean, it is undoubtedly true that we need to expand balance sheet of banks to support good economic growth, and the country needs banking risk capital. Where is that risk capital going to come from is a question we need to answer. Thank you.
Thank you, sir. It was an enlightening address. We are sure the students and other participants learned a lot from your address.
To give the vote of thanks, we have Professor K.K. Rai, Area Chair, Finance, KIIT School of Management. In a career spanning more than a decade, he has served in leading national level institutions in the country. Indian Institute of Forest Management, Bhopal, Indian Institute of Management, Raipur, and Institute for Financial Management and Research, Chennai, to name a few. Dr. Rai regularly conducts management training programs for corporate and government executives in finance and related subjects. His research interests are mainly in the area of corporate finance and financial markets. I request Professor Rai to give the vote of thanks.
On behalf of our founder, Dr. Achyuta Samanta, and our director, Professor Mahapatra, I take this opportunity to thank Professor S.N. Misra for his welcome address, and Dr. Ajit Ranade for his keynote address. Professor Misra, he mentioned about the significant disruptions that happened during the pandemic in last 2 years. And he viewed that the stimulus package, which is declared by the government, has helped immensely to the organized as well as unorganized sector in the country. And he mentioned that India has managed the pandemic very well, and he is very much optimistic that in future as well, the economy will do well. Thank you, sir. Dr. Ranade, he has touched all segments and all instruments in the financial sector. And also he talked about the phase-wise evolution in the financial sector and how there is a shifting from that your financial sector should develop fast and that your economic growth and development that will follow. And he mentioned about the cryptocurrency, then Paytm listing losses. Also, he talked about the bad bank kind of your concept, which is come out very strongly from the government to reduce the bad loans made by the financial sector. And at the end, he has mentioned that we need to improve the saving through financial sector for economic growth. And he was talking about that the digital disruption is increasing for the banking and financial sector, and that needs a kind of regulation. And he was talking about that financial sector is the exciting sector, but that inequality that is happening in the wealth, okay, that should be regulated. So what I can say is maybe many questions that is came from the students on stock market as well as on cryptocurrency, because in last 2 years, maybe if we see the students, they have participated much in stock market as well as in cryptocurrency because of online classes and other things. So maybe because of that, students, they have specific interest in stock market and crypto. Sir. Thank you very much, sir, for your impressive speech. I'm also thankful to all the panelists of panel 1 and panel 2. Panel 1 that we had in the morning, and the panel 2 that is going to happen after this inauguration session. And I'm thankful to all the panelists for sharing their views on the topic that is assigned. I am thankful to all my area colleagues for their sincere effort towards successful completion of this conclave. Thanks are also due to Professor Kumar Mahanti and his CR team for their support in Corporate Connect. Thankful to Professor Sugato and Vishwajit Patnaik for their cooperation in conclave preparedness. I am also thankful to other faculty colleagues of School of Management for their support in the conclave process. Thanks are also due to Mr. Samavesh Nayak and his team for logistics support, Subratam and team for ICT support, Amit, Manas, Ranjan, Narayan Barik for their conclave assistance. This year, we received massive response for our business idea and finance quiz contest. More than 1,000 participated in business idea contest and above 5,400 in finance quiz from almost all the national institutions in the country, as well as from 11 foreign universities. So I am very much thankful to all the participants in those contests and congratulating to all the winners. Last but not the least, I'm thankful to all the student members of Finance Club, that's KIIT, led by Sayantan, for their rigorous effort in promoting and completion of all events of the conclave. Lastly, I thank all the students of MBA, BBA of School of Management and other schools of KIIT University and audience for your presence and participation today. Thank you. Thank you all.
Thank you, sir, for your kind words.
With this, we come to an end of the inaugural part of the conclave. The link for the second panel discussion will remain the same. I request the participants to kindly be logged on. We will begin the panel 2 discussion immediately. Thank you.
Good afternoon, ladies and gentlemen. I, Shresh Sharma, a student of MBA first year, welcome all esteemed guests, distinguished speakers, corporate delegates, respected faculty members, and my dear friends to the second panel discussion on the topic, Decoding Sectorial Outlook, Emerging Economic Paradigm and Way Forward. This panel discussion is a part of 12th National Finance Conclave of KIIT School of Management on the theme Resilience in Economic and Financial System, Lesson from Disruptive Changes. Now, I would like to introduce our moderator for the second panel discussion, Dr. Praveen Mahanti, Professor, KIIT School of Management. Dr. Mahanti is a professor of economics and finance at KIIT School of Management. Prior to KSOM, Dr. Mahanti spent over 20 years in the financial sector, working for organizations like ICICI Bank, Aptiva Consulting, Sri Infrastructure Finance, Edelweiss Finance, and in diverse roles. Over the year, he has developed an expertise in the area of risk management, structured finance, and infrastructure project finance. His current research interests are in the area of financial risk management, microprudential regulation, and corporate bankruptcy law, and banking NPL. Dr. Mahanti earned his PhD in economics from the University of Southern California and got his master's degree from JNU. Sir, I request you to take over the session.
Thank you, Shrestha, for this for the wonderful introduction. Good afternoon, ladies and gentlemen. it is my pleasure to welcome you to the second panel discussion of the day on decoding sectoral outlook, emerging economic paradigm, and the way forward. We are fortunate to have with us a panel that has decades of experience in the key sectors of the economy, and we expect to get some deep insights into the sectoral growth experience and the future outlook. Let me begin by welcoming the panel members. The first panel member is Mr. Manish Saxena, who is Chief Financial Officer at Adani Enterprises Limited. He's a seasoned finance professional with over 30 years of experience in operational and strategic finance. He's worked with the telecom industry for more than 13 years. In the telecom space, the last position held was finance controller with Aircel. He worked with Aircel for more than 9 years, also holding position of board member across companies of Adani Groups. He has an expert knowledge about direct and indirect taxation and has adopted most foolproof strategies about complex taxation matters. Finally, he has hands-on exposure about IBC, which is a new way of work in the corporate world. Welcome, Manish, to this panel. The next panel member is Mr. Nikhil Dujari, is the Chief Financial Officer at GMR Energy Limited. Nikhil is going to join the panel a little late. He had some pressing engagement, but he'll be joining us very soon. Nikhil is a chartered accountant and a CWA and brings with him a rich experience of over 24 years. He started his career with Ernst & Young and later joined Pricewaterhouse in its assurance practice. 4 years later, he moved to Alstom for 9 years in multiple roles as the India head of controlling and area finance director of their equipment services and maintenance business. After which he moved to head the finance function with New Case Holland for 3 years. He was also the CFO of Everest Industries Limited prior to moving as the CFO of GMR Energy recently. He has been widely accredited to redefine the working capital strategy at New Case Holland and Everest Industries, resulting in significant cost benefits to the organization he served. He has also been associated with the Institute of Chartered Accountants of India and was a member of the Internal Audit Standards Board for 2021. He also serves as the General Secretary of the governing body of Sahid Bhagat Singh College Alumni Association. Welcome, Nikhil. Our next participant and panel member is Ms. Kanika Pasricha. She's an economist with the Standard Chartered Bank, India. Kanika provides macroeconomic research for the India economics team. She previously worked for about 8 years in the Treasury Research Group at ICICI Bank, where she specialized in macro and policy research on the Indian economy. Apart from India, she has extensive experience in research on emerging market economies with special focus on China. Her papers have been published in international journals, and she has received media coverage for her work. Kanika has been involved in projects providing policy recommendations to the Ministry of Finance. She holds a master's in economics from the Delhi School of Economics. Our last panel member is Mr. Dinesh Bansal. Dinesh is a cost accountant and a chartered accountant by profession and currently works as President Finance in the Bajaj Group, Mumbai. Dinesh has more than 25 years of work experience handling corporate finance, where his major role centered around fundraising for big infrastructure projects like ports, logistics, aviation, shipping, power generation, power transmission, green energy, oil refinery, etc. Dinesh has been associated with the Bajaj Group for the past 6 years, prior to which he served as the CFO for SR projects. hydrocarbon business for 2 years. Welcome, Ganesh, to the panel. In the first panel discussion, we had a very interesting discussion that deliberated on the resilience of the financial sector in dealing with the disruptions caused by the pandemic. We will continue the broad theme and dive into the sectoral growth outlook in view of the challenging economic environment during the past decade. Especially in the post-Great Recession period, we have seen economic disruptions or shocks caused by demonetization, GST, banking crisis, and then the pandemic. There were also disruptive changes, especially digitization of markets, payments, fintech, artificial intelligence, and big data. That is also transforming the way businesses are structured in many industries. So let me begin by asking Kanika to lay down the macroeconomic evidence for the sectoral growth trend in view of the disruptive changes and how it has changed the growth outlook, especially how commodity price cycle has impacted different sectors, especially the energy sector that is going through some kind of a crisis at present. Over to you, Kanika.
So thanks a lot, Praveen. Am I audible?
Yes, you are.
Thanks. In fact, as you stated, taking cues from your question itself and for the sake of students, just before talking about the COVID-led disruptions, as you rightly pointed out, let's take a step back and understand that disruptions in India started way before. It started with demonetization in October 2016, then GST in mid-2017. Of course, that was also the time when India consciously went into a formalization of the economy mode. And this was government's intent as well. That leads to disruptions. Some players benefit, especially the larger corporates, the formal sector corporates, while the MSMEs, which are in the informal sector, they got disrupted. And the ones that got tagged along with the larger corporates in the overall business supply chain were still healthy. But what's very important is that whenever disruptions happen, there is a short-term slowdown. In the medium term, it does bear fruit. And post-COVID, there are some positives also coming out of the disruptions earlier itself. So first and foremost, demonetization, GST, that time they were banking sector issues. So pre-COVID itself, the Indian economy was slowing. You would have read in your course as students that, whenever you talk about Indian economy's potential growth, that's C plus I plus G plus X minus M, anybody would tell you the medium-term growth should be at least 7 to 8% for us to say that India is actually growing well. But instantly in FY20, means just pre-COVID, we actually grew only 4%. Because since, I would say FY12-13 itself, India had consistently seen decline in nominal GDP growth. In fact, from as high as 20% to single digits, which is why Dr. Ranade also was referring to consistent decline in credit growth, which is again low. Banking sector issues, sorry, the NPAs were higher. Job markets, there were issues, so consumption demand was coming down. And more importantly, private capex contribution to GDP was coming down. Government support to growth was vital, but there was a fiscal fetish. They wanted to preserve their deficits at a certain healthy level so the rating agencies don't actually downgrade us. So there was a fiscal fetish as well. Government contribution to growth was limited and the economy was in a slowdown mode. But the disruptions were leading to this change of formalization and digital adoption. Now, when COVID happened, once in 100 years event, of course, the global economy was in a turmoil and India also faced issues. So last year, our GDP actually contracted. GDP is a gross domestic product. You would have read about it, the actual annual output produced by an economy. It actually contracted some 7.5%, unforeseen, 100 years event. Now, till such time, this uncertainty on again, eruption of COVID outbreaks, first wave, second wave, Delta, Gamma, Beta, Theta sort of variants on COVID. There was an uncertainty around it. We actually saw that the manufacturing sector, services sector, the corporates were actually in an uncertain phase. But yes, now with the vaccinations coming in, and actually the government also taking a conscious call of lives versus livelihood debate, we know that even if we'll have more COVID outbreaks, the extent of economic impact will come down because there will not be any further lockdowns. But what's very important to note is that vaccination pace has improved, it's healthy, and currently COVID infections are low. God forbid, festive season, people have actually got into a COVID complacency. We should not have another wave. But as of now, things are looking fine. Yes, risks remain. Can't deny that. Vaccination progress needs to be at an even better level, but still things are better. So last 3 to 4 months, I've seen a complete shift in commentary. And it's not just about data, which we can keep quoting. It's also about our business commentary. I'll give you an example. 3 months ago, I met the credit team in the bank, in our bank, Standard Chartered. And they were actually also handling particularly the MSME portfolio. So the commentary was, we don't know what's going to happen. The second wave has just ended. The government's policy support, frankly, has been limited. While yes, it was significant, but government in India, as Dr. Ranade also pointed out, always has had very limited resources. So direct cash injections, doles, transfers to boost demand, the government's capacity was limited. So what we actually saw is that in the commentary was the government is not willing to support as much. Of course, commodity prices are another pain. They're already started to rise because after every crisis, we see a recovery in commodity prices. Supply always takes time to catch up to demand and commodity prices spike. And the growth indicators were also showing very gradual recovery, volatility as well. But now, especially post Diwali, with festive season sales surprising everybody, they were like higher 75% up once, highest in a decade. The growth indicators, be it GST collections, second highest, toll collections, GST e-way bills, freight traffic, all that is fine. So all that is actually showing that there is a revenge buying, pent-up demand that's coming out. That's a source of solace because pent-up demand, and of course there's a base effect from last year, is giving everybody confidence that growth this year will be at least 9 to 10%. We are at 9.5%. But there are some important points to note. First and foremost, is the recovery even? No, it's uneven. That's why you would have been reading in newspapers, everybody calls it a K-shaped recovery. As Sir pointed out, there's a sectoral divide clearly. For instance, manufacturing has been quick to recover because they are getting demand for goods. For us also, we are buying a lot of goods on e-commerce platforms from the markets. But demand for contact-intensive services, tourism, hospitality, restaurants is still taking some time to come back. Yes, there is a revenge buying there as well, but it's still not back at pre-COVID level. In fact, far from that. Second, within sectors, as I stated, whenever after a crisis demand starts to recover, supply takes time to catch up. So we've seen disruptions happen globally. Shortages of key inputs into manufacturing. For instance, auto sector is under pressure due to semiconductor shortage, chip shortage. Broadly, trade-oriented manufacturing sector is under pressure because of freight issues, container shortage issues. Third, and most important, as Sir pointed out, is the energy price spike. Can you imagine last year when COVID happened and global economy was in a turmoil? The oil prices touched lows of $20, $25 per barrel. This year, they've already seen a high of $85, $86 per barrel. Last seen in 2018. And actually, it's purely supply issue. And the suppliers also are not willing to prop up supply at a reasonably healthy pace because they also want to get some fruits out of or at least want to limit their losses from the pandemic, which is making geopolitics become a very important part of the energy market. We think US will use its political might and eventually energy prices are likely to move down to 70s rather than 80s, and eventually maybe in 12-15 months time to their fair value of 60s. But we are in a new normal now. We know that economy is in a recovery mode. Yes, there are disruptions, there are change in drivers. For instance, larger corporates are outperforming, especially the commodity intensive ones, while MSMEs are still lagging. In mind you, government support there is needed in terms of job creation. Some 5 million jobs have already been lost in that sector and they've not yet come back. So there are some unevenness, some challenges, but we are in a recovery mode. So just from headline perspective, numbers are 9.5% expected from growth this year. Next year around 8%. But post that, are we expecting growth to come back to pre-COVID levels or outperform and stay that golden 7-8% mark? The answer is no. And I'll just quickly list down 2-3 points. First is what Dr. Ranade stated. Banking sector is still under pressure. It still needs some more support, and the government has various competing policy priorities. Second, there's a risk that if commodity prices stay elevated, they don't cool down while there's a correction expected next year, then policy normalization, because post-COVID, the central banks have been very quick to normalize policy, cut rates drastically to record lows. They may be forced to implement a faster than expected policy normalization or tightening cycle that may weigh on growth or limit growth recovery in order to contain inflation, because commodity prices are an issue along with supply issues. Third, we need more government support when it comes to job creation, because income growth needs to exceed, the wage growth needs to exceed inflation for us to feel rich and have a sustained consumption growth. Consumption demand sustainability is very important. We are a consumption-led economy. 60% of our GDP is consumption. Fourth and last, very important, private capex needs to come back for a sustainable growth recovery. As I stated, since FY 12-13, private capex has been declining as a share of GDP. Our view is it's coming back slowly, but only in some sectors. For a broad-based private capex recovery, we need capacity utilization in the manufacturing sector to exceed 75% sustainably. That's still not the case. It's still below 70%. Government is implementing efforts like production-linked incentive scheme for the private sector, for various sectors. It's very successful in the high-tech electronic space, mobile space, to crowd in more private sector investment. But we've got to see more such efforts, successful implementation of government schemes for private sector to come back, because in the C plus I plus G plus X minus M space, C needs support for sustainable recovery. I needs private capex to come back. G, government is spending. X minus M, as the economy recovers, is always a drag on growth because we are a net importer nation. So we need some more policy levers to see credit growth come back to double-digit levels, nominal GDP to sustainably stay in double digits, and for us to actually come back or have a sustainable 7-8% golden GDP growth numbers. Thanks.
Thank you, Kanika. As you take a cue from you, the investment, the private sector investment over the last almost 5-6 years has been on a downward trend. As you mentioned, some of it is recovering. We see some green shoots in sectors. And we are lucky to have panel members who belong to the core industry of infrastructure and hydrocarbon consumer goods. So let's hear from some of the corporate experts. I will invite Manish to share what is happening in the Adani enterprises we belong to, or in your sector. What's happening to the investment cycle? Do you see a uptick in the investments? And what do you, in your opinion, how is the growth trajectory in the sector going to look going forward in a couple of years' time? Because next couple of years, this financial year and the next financial year, we will just be recovering from the pandemic with a lot of pent-up demand and other. But to have a sustained growth from FY 23-24 onwards, what kind of investments are you seeing in your sector and in other sectors in the economy? Over to you, Manish.
Thanks, Praveen. Good afternoon to everybody, students and fellow panel members. I hope I am audible.
Yes.
Okay. So Kanika set the context, and in the first panel, though I didn't, I couldn't log in much earlier, but I think I logged in around 15 minutes prior to beginning of our session. So the way I have, as you introduced me, that I have around 30 plus years of experience. And the word VUCA, I had heard when I stepped into the corporate world. Since then, VUCA has been part of my life. There have been various VUCA movements, and for the younger students who may have not heard VUCA, but may be thinking pandemic is some sort of VUCA, if the Google would have told you that. So it is short, it is an abbreviation which means vulnerability, complexity, and various other types of negative adjectives which you can think of are associated with this, right? But to be very honest, I have lived my entire 31 years of corporate life in VUCA. I have become stronger by each and every VUCA moment which came in corporate life. Our companies became much more stronger. And for you young guys, I can only say one line, that I am feeling jealous of you guys, because I am going to finish off my corporate innings in the next few years. I'm in the last few overs of my 2020 match, right? You guys are just starting. I'm having goosebumps actually, because you people, when you are going to start your corporate innings, even prior to that, you have experienced VUCA, which has rattled the globe. And whenever these type of moments come, it actually differentiates between a leader and a crowd. Now, here is the moment which is, I would say, it's a godsend opportunity. So for individuals and students of any university who are wanting to step into the corporate world, or currently as the fad is, we want to become a startup entrepreneur because we want to create a valuation like Paytms of the world, Flipkarts of the world, whatever you will be wanting to do, it ultimately boils down to how much gritty you are, what resilience you show as an individual. All organizations are an aggregate of how resilient the leadership is, what is the vision, what is the growth forward you have charted for yourself. Coming back specifically to what Praveen asked me, that how did pandemic impacted us and how do we look forward at the Adani Group? We are a listed company. We have got around 6-7 companies which are in the listed space. Our chairman Gautam Adani is making various statements through the chairman's speech or through various media pronouncements. So it is all over that we are looking forward to a very different type of country in the next 5 to 10 years. And with the geopolitical forces, I think it is going to be a golden moment of the next 10 years, out of which I will be serving at least for the next 5 years before I say goodbye to the corporate world. I think it's one of the fantastic moments for India. The beginning has already been done by Madam Nirmala Sitharaman by changing the corporate tax rate to 15%. And you have seen, this is all not sloganing. It is all happening in India. New companies are getting created in India to take the benefit of 15% of the corporate tax rate. And that is why companies which were putting up their headquarters in Philippines, in Vietnam, they all have started coming to India. Lot of migration is getting out of China. As per my individual assessment, and I don't give this statement attributed to the Adani Group, I feel personally, whatever little, though I'm not a student of economics like Kanika is, but I have a lot of interest in economics because I understand economics is the fundamental of any business activity. If you don't understand the economics of the business which you are in, sorry, you will always have a bleeding P&L. Hence, you need to understand, first of all, global economics, national economics, and then the economics of the product, what you are doing. So We think China's lot of space will be occupied by India. We will have lot of exports, which will rupee is going to appreciate significantly. I have never experienced in my 30 odd years of corporate life that rupee would have, from a point to point, there will be moments or months or weeks where rupee might have appreciated against the dollar. Next 10 years, I would want to exchange my notes to you young guys who would be becoming CEOs in the next 10 to 15 years, who are coming into stepping world, into the corporate world. I am 100% sure rupee is going to appreciate significantly, and it's not an emotional statement from my side because I am a patriotic Indian. I believe strongly that economic fundamentals are indicating to a huge turnaround in favor of India because of various things. Recently, when Prime Minister was in Glasgow, he made out something very, very fundamentally known to all of us, but it was never articulated in such manner. One sun, one world, one grid, right? Everybody knows that sun never sets in the entire part of the globe at any point of time. In some part of the globe, sun is always up. Why can't we use the sun power called as solar energy to generate power in one part of the globe where sun is up and transmit it through the transmission lines to the remaining part of the globe? We always say in India, we are in various types of energy. We are in renewable, we are in thermal power, we are in green energy, we have transmission, we are in all parts of energy and mainly infrastructure business. For us, we feel that it's a golden time right now. अपना भी टाइम आएगा नहीं, अपना भी टाइम आ गया है, and this is valid for India, not for Adani Group. And I'm very excited and I feel actually very jealous of you guys who are stepping into the corporate world. I have seen various ups and downs, those downs which Kanika was mentioning in her opening remarks of low single digit GDP growth rates, right? Because the GDP grows low, your corporate increments are much lower than that, and hence you personally get impacted. Guys, this is the exciting time ahead. Yes, definitely rules of the game are getting changed. Like for us, ESG has become a mantra. And what is ESG? Because we are into power space. Yes, we are, world is looking at coal as if that it is the biggest villain of economy. So there has always been a fight between economy and environment. Now, which one should take precedence? Should environment take precedence? Should economy take precedence? So the world is divided. The debate, I am not a subject matter expert on this, but I'm a finance guy. But in our company, the mining resource business, which I am the CFO, I am trying to navigate the ESG journey as far as mining business is concerned. And we have taken numerous steps, which even the companies which are leaders in mining space like Coal India, even they don't have. So ultimately, it boils down to leaders' burden. Now, when you are a leader, you also have a burden on your shoulders to lead from the front and don't only look at the government, what government is doing for the corporate world. We have a huge investment plans. It is all in the listed space because we are listed companies. It's all there in the public domain. I don't want to repeat the gory details. It's all there. But we are very, very excited. We are diversifying. We till now were only in B2B space. Now we are getting into B2C. This airports is a B2C example of that. We will provide a very different type of experience to the commuters who are visiting airports. Just wait for 3 years. Indians would never have seen that type of airports which we are going to transform into. And it requires huge amount of investment. And yes, we are approaching all sort of the most optimum type of lending rates. Definitely because we are huge capital guzzling group, and the more capital you guzzle, the more employment opportunities you create. We are very proud. Our tagline of our group is growth with goodness. So we just don't believe in growth in the top line and the bottom line. We also want to spread goodness all around in the society. We do lots of corporate social responsibility work, not only that which is mandated by the Companies Act, but much beyond that. But we don't publicize that much because we think that we need to be humble. We need to be ground footed, and we do a lot of work in the tribal area because mines are always in the villages and in the tribal areas. And in the past 1.5 years, had our mines not been operating, I'm thankful to all those miners who were there 24/7 by 365 producing coal, so that the power plants of the country are generating power. Not even for a single day those power plants had to shut down because there was no coal. and the law and order was completely confusing. Nobody knew what sort of rules and regulations to be followed, which are COVID protocol. But finally, we have been there, done that, seen it all. And I think you guys are going to benefit tremendously as far as soft skills are concerned. Soft skills are generally not taught in any of the colleges. I'm not too sure about KIIT, that how much you focus on the soft skills, but I can tell you guys and that soft skills definitely create a huge amount of difference between who will become a CEO and who will become a successful entrepreneur, and who will get into the category of been there, done that, tried it, but not successful. Soft skill is that differentiator. And this pandemic provided that structured method, a structured environment to people to test their grit, to test their resilience, to test what all skills you can add to yourself. So I think times are wonderful ahead. I wish each one of you a glorious career ahead, and all the very best to you. Over to you, Praveen.
Thank you, Manish. The Adani Group is definitely in the forefront of investments in infrastructure. And our next panel member that I'm going to turn to, Dinesh, also has a lot of experience in the infrastructure sector. So my question to Dinesh would be in twofold. One, on the infrastructure sector, with the national infrastructure pipeline and other investments that is being planned by the government and as well as the private sector, where do you think, what are the timelines? Will we be able to meet the timelines that were set by the Honorable Finance Minister? Or has the pandemic kind of derailed that process somewhat? My second question would be, is in his current role with the Bajaj Group, he must have experienced a lot of disruptions due to the pandemic. The latest numbers that came out for automobile sector is almost showing a decadal reduction in demand, and the sector has not performed as well as was expected by everyone because of the pent-up demand. So I want to have your take on that as well. So Dinesh, over to you.
So good afternoon, everybody, and thank you for inviting me here. So I cannot agree more with Manish that next 10 years is a golden period for India and for the corporate particularly, so who are into all this transition phase, particularly energy sector. So in Bajaj, we are into energy space, we are into thermal energy, and we are the fourth largest sugar and ethanol product producer in the world. So I'll take you through the energy sector and transition, which working say 15 years, working 25 years in leading industry players in infrastructure and energy. So my sense is as follows. In energy space, India has huge growth potentials, particularly looking to the increase in population. Right now, we are around 3 billion, and the population is going to increase. And further, if you see, we have a growing economy. The economy is projected to be like say 5 trillion GDP by 2025 and $10 trillion. An important point to note here is that even though India is third largest consumer of energy, but however, in terms of per capita energy consumption, we are much lower, and we are 1/3 of the global average. So in fact, so energy sector is directly correlated with the economic growth. Unless until we sort out all issues which is related to energy, we cannot grow what we are projecting to grow. So on the second side, if you see, in terms of import, in terms of energy requirements mitigation plan, so we are totally depending upon import of energy. So you may be knowing that we are importing approximately 85% of oil, 25% of coal, and 53% of gas as an import in the country. which has huge outgo in terms of foreign exchange. And parallelly, we have a commitment to reduce our carbon emissions. And by using this fossil fuel, it will be a far-fetched things. So we need to set the equation where we need to see that how to mitigate the potential growth in the energy sector. And secondly, we need to see that how to decrease the dependency on imports and save foreign currency going forward, because that will strengthen the balance sheet of India as a whole economy. So government has taken various initiatives. So I'll talk about initiatives taken by Bajaj Group also. But first of all, India has taken various initiatives. For example, everybody knows that for renewable energy, government set a target of 500 gigawatt by 2030, which will meet approximately 45% to 50% demand from renewable energy, which is currently at 18% to 19%. In short-term targets, 175 gigawatts is likely to be achieved by 2022. And in my opinion, in my sense, India is on track to achieve that target. So second initiative in terms of ethanol, because in Bajaj Group, while we produce sugar, and we are the largest producer of sugar in India and fourth largest in the world, we have a big capacity to produce ethanol from molasses. So India is promoting ethanol as a biofuel to blend 20% in petrol in order to mitigate three things. First thing is that it will encourage biofuel in the economy, because the automobile industry can run on the biofuel to reduce carbon emissions. Second point is that so government or India can save foreign exchange out of that, because this 20%, which will be leading to approximately 1,000 crore liters, will be replacing import of oil in the country. So it will be a foreign exchange saving to the country. And government is giving various initiatives in order to promote ethanol production from the molasses. For example, sugarcane, grain distillery, government is encouraging to set up so that more production of ethanol to mixed into petrol can be achieved, and we can provide biofuel and we can save foreign exchange to the country. Similarly, in these initiatives, green hydrogen is also top of the street, because this green hydrogen will decarbonize and reduce import bill of the country. And it is projected that it will replace fossil fuel, particularly in petroleum refinery and fertilizer by 2035. And blending of green hydrogen will be there in city gas distribution up to 15% by 2030. So in fact, green hydrogen is also a good initiative which is undertaken by the government in order to reduce the import bill, in order to reduce the carbon emission in the country. And fourth point, which I want to highlight, is that transformation in the mobility sector, where key drivers include shift in the mode of transportation and electrification of entire transportation, and providing flexi fuel in terms of ethanol to the transport industry. So this all initiatives taken by the government will have huge impact on economy and social front for the country as a whole, because it will definitely lowering the dependency on import of energy and fossil fuel. It will save foreign exchange outgo, where green energy is must for net zero energy import by 2047, which is 100 years of independence, which we are projecting. And so, the current energy import is approximately 160 billion today, which is continuously rising and estimated to be reached to USD $320 billion by 2035. By transitioning into green and clean energy, so all these points, all these things can be taken care of, which will attract huge investment and it will generate employment in the country. With this whole initiatives, with this whole transition, in my sense, the corporate world, entrepreneur and investors ecosystem is very much upbeat about it, because recently we all aware that big corporate houses, big business houses in India, they have announced investment plan. For example, Reliance has announced 750 billion rupees for next 3 years in renewable energy space. Adani has announced 70 billion commitment in next decade to become world largest RE power company and produce cheapest hydrogen on earth. Similarly, GAIL has already started mixing green hydrogen in natural gas in city gas distribution system. NTPC, IOCL, NLT, all these big corporate houses are taking strong initiatives to promote green hydrogen and taking that as an opportunity. So basically, my point is that, so right now, with this transition, so Indian economy and Indian economy as a whole will get benefited by that, because right now it is lopsided in favor of oil import or energy import and huge foreign exchange outgo. In terms of Bajaj Group, we are, as I mentioned, we are into sugar space, where we have India's largest installed capacity for ethanol manufacturing. So we are, it's a biofuel promoted by the government. Government is announcing good prices for raw material and promoting concessional loans to set up the distillery based on the food grain, based on the sugar cane. So going forward, definitely we would like to expand our business of sugar into ethanol space.
Thank you, Dinesh. There's as you pointed out, there is a lot of investments that has been planned in the green energy sector, especially in solar energy by the major groups in the country, Reliance, Adani Group, and many other. GMR has been one of the leading energy companies. So let me get Nikhil into the discussion. Nikhil is with the GMR Energy and is a major, GMR is a major player in the infrastructure sector. So other than energy, they have interest in airports and other businesses. So Nikhil, where do you think is the investment, the gross investment scenario in the economy headed, and especially what are the plans of the energy sector which you represent in terms of investment? Over to you, Nikhil.
Thank you. I guess the big ticket change that is happening today as a result of the pandemic is that everybody is starting to work flexibly. And in this flexibility lies a huge opportunity, because historically with dual employments, the daytime power consumptions of households had dipped to a historic low, and now that has changed. Now, vis-a-vis that, historically, the office time power consumptions have come down. So that's a paradigm shift in the way people look at things. Now look at it from an economic perspective. The perspective changes because the domestic power consumption attracts a power pricing which is significantly lower than the commercial power consumption which was used in the offices. And probably factories and offices were really the cash cows of the so-called discoms. With the privatization of discoms and a change in the methods of distribution, so distributed solar is going to be times of the future, and there's a huge investment that's happening on the solar aspect of power. Additionally, when you look at the infrastructure, with people migrating back to villages and work from home scenarios, the infrastructure investments in the village economy have really gone up significantly. there's a huge change in the basic infrastructure that India's villages had 20 years ago versus today, in terms of the quality of roads, the power availability, the need for the internet and internet availability, the quality of household construction. Today, no matter where you go, you will hardly find a kacha house. So what do you mean by paka house? A paka house, does it mean essentially a roof that is RCC, or does it mean an asbestos cement roof or a metal roof? So again, the paradigm shift in the quality of households shifted towards asbestos cement and metal, and now with migration back of people into villages, they are also getting back into better quality homes, which essentially commands a huge infrastructure spend. So no wonder that paint companies and other construction material companies have done exceptionally well over the period. The other part that is changing is this world is really on artificial intelligence. There is going to be a huge element of investment that is going to be made on automation as opposed to investments in computerization. So historically, the paradigm was to install a computer, versus today, the paradigm is the end result of what you're doing out of that computer and how much more can you get out of that computer, such that there is minimalistic intervention of humans into what they are doing. As you notice, I'm also doing this in an eco-friendly place. I'm right in the middle of a lawn. As we are talking, this technology was probably not feasible maybe a decade ago. Today, as we talk, the physical placement of people really doesn't make a difference. So again, there's going to be a huge element of thought and investment that is going to go into India's infrastructure as to how people can do their work at leisure, which also will take into account a huge change in the quantum of, if I may use the word, the pressure or the emotional tensions people used to carry are going to shift again. This is essentially brought back a huge amount of focus again back onto the family life of individuals. Now, how do you actually attribute that to infrastructure change or to a global economic change? The change that is attributed is that historically, if you had a two-bedroom house, that was good enough for you. However, today, when you have children, two children doing their classes, the two bedrooms are already taken, and the husband and wife need another two places to sit for their office. So you would also see that paradigm shift in the investments in the housing sector, with people wanting to take one additional room to be able to take care of how the pandemic is going to perform. There's one more change that has happened in the psyche of people when you look at it. Today, using your own car is a preferred method as opposed to taking a small flight or a small train ride or a bus ride, due to the social distancing and safety aspects of it. The one more industry that's taken a huge leap is the contributions that our female colleagues and our brothers, sisters and mothers used to make to us. But there's a huge number of home cooks, etc., that have arrived. What do they add to the infrastructure? Those people who were earlier unemployed are now being used by them for delivery and ancillary services. So that's again an area where those people who were earlier using cycles or were on foot are now buying two-wheelers so that food can be delivered faster, and Zomato could not be coming at the more appropriate time. One more thing where we see a shift is use of electronic means of currency. You'll notice that each one of us has a Paytm attached to their telephone. So today it doesn't matter whether you are carrying your wallet, even a vegetable vendor actually accepts a Paytm. So imagine the amount of investment that has gone in towards the servers, connectivities, internet, and all other ancillary services in relation to this. In the banking sector, when we look at, notice also that most payments are now being made electronically. So you would notice that probably in the last 2 years, there's hardly a time we've actually used a checkbook. We've all done it electronically. Imagine the amount of paper that it is saving annually for the nation as a whole, as also the element of staff that banking sector can reduce because customers are doing what their staff was supposed to do. And in that, investments have been made in technology to be able to take into account. So if I was to look at the overall investment scenario, imagine all the savings that were made as a result of the government spending cuts due to the pandemic, because their offices were not operating, because their vehicles were not operating, have either gone to contribute to the country's defense or have gone to contribute to a better healthcare infrastructure with the world's largest, program for COVID-related vaccination conducted by India. Now, if I was to look at the entire scenario, these were things that were probably capable, not capable of being thought of a couple of years ago. If I have to look at the energy sector itself, we were talking of shortage of coal. Suddenly we noticed that Indian Railways started a Sheshnag Express last year, which is amongst the longest trains in the world. Now, that means that with relatively lower per capita cost of transportation and lower logistics costs, we have made improved use of the same infrastructure. So there's going to be a huge investment that I do believe is going to come into improvised uses of infrastructure. Look at school and college buildings that have not performed their asset related tasks over the last couple of years due to the pandemic. Everything was going on, education continued. So there is going to be an element of change in the thought process from the erstwhile most economical and most efficient to the latest trend where how you can make things happen is going to take precedence over what is going to be most efficient to do it within the given time constraints. That's also pushed forward the pace of delivery of major infrastructure projects, and that's again something that is that kind of speed was not heard of in the past. So I think there's a huge change that is happening on this side. There's also a huge amount of private investment that's coming in, whether you relate it to Air India or whether you relate it to the solar capacities or the rooftop power or the distributed power or highways or the national infrastructure. Today, India's airports are amongst the best in the world. Today, India's power infrastructure, you don't, so when we were all children, we've seen times when we had an 8-hour power cut and we had a 12-hour power cut. Today, tolerance limits don't go beyond a 1-hour power cut. So naturally, that's a paradigm shift. Each household today is looking at alternative renewable means of fulfillment of their power needs. The e-vehicles that are going to come in are going to infuse a huge need of power once again. And a back of the envelope calculation, if I was to make, if I was to say that there is 100 two-wheelers in the ecosystem, each two-wheeler to recharge the battery would typically need about 100 units of power that some households consume over a monthly basis. So imagine a situation where you have the Delhi International Airport and the entire rooftop is today vacant. You can convert your factories and your places of work into income generating assets that are going to recharge the global charging need for the vehicles in this country. And that's going to be one major change that I expect where investments are going to be made. Thank you so much.
Thank you, Nikhil. That was a really broad overview of the future technologies. Let me take the cue from there and ask Kanika. So if you could just mute yourself. Yeah, thank you. So let me ask Kanika that there are many changes we have seen in the last few years, starting with, as Nikhil mentioned, digitization with payments, artificial intelligence and big data impacting almost every business today, and the new focus on the environment in the backdrop of the recent COP26. So what do you think, Kanika, is the impact of all these changes on different sectors, and how are they? I'm sure it's going to be a growth positive, but to what extent do you feel that we are going to gain in efficiency in by using these technologies, in reducing inefficient manpower, redistributing labor? So your thoughts, Kanika.
Sure, thanks a lot. In fact, before I start on this question, while I'll just guide the students, see, economists are always known to be cautiously optimistic. So they'll always give you risks. While people from the corporate sector are always more optimistic, more forward-looking, and actually, especially getting the cues from our esteemed panelists, other panelists in this panel, I'm actually getting more optimistic about that which is a private capex. The comments were more restricted towards the energy sector, yes, and beyond as well. But yes, there is a virtuous cycle at play, and I hope the risks don't play out. So you are in a good space, especially 2 years from now when you actually are future ready for corporate world. But quickly on the digital piece. See, first and foremost, we started with demonetization GST. But years ago, the government also started with JAM Trinity, means Jandhan, Aadhaar, and mobile. And that was the initiation of digital disruption in India. Of course, the adoption has been faster because mobile, today all of us know, like, of course, when I was studying in college, I didn't have a mobile. Today, nobody can dream to live without a mobile and not changing it every 2 years or no. So now out of 135 crore population, more than 100 crore people have a mobile. Of course, not all of them have a smartphone. Around 60% of this is actually smartphones, but yes, they have a mobile. And can you imagine the cost of the tariff rate for internet in India is 9 cents per GB, while in the US it's 800 cents per GB. So it's like one of the lowest in the world in terms of the cost of data tariffs. And that was also the initiation of digital disruption created by a corporate in India itself. So this whole thing about digitization, mobile use, mobile payments, using JAM Trinity, that is Jandhan, Aadhaar identity, to actually initiate payments from the government's end as well, directly into the bank account via in a digital form, is all part of the digital disruption. Post-COVID, we've seen that expedite immensely, as Sir pointed out. And it's not just about digital disruption in India, in the form of digital payments, AI, fintechs coming up, so many things happening. Nikhil sir also talked about health infrastructure, where in fact technology has made inroads into every sector. But most importantly, before getting into other sector specific inroads by technology, the bigger theme here is that India was always a services-oriented economy. 60% of our GDP is services. Now, government thought that, of course, India also has a demographic dividend. So around 200 million people enter the workforce every year. So the government thought that services has already reached a saturation limit, and there's a need to boost manufacturing as a next source of growth and jobs driver. which is why you're hearing about production-linked incentive scheme for the manufacturing sector. You're calling for global champions, domestic champions. You heard about, so talk about the national monetization pipeline, national infra pipeline. We're all hearing about all these initiatives by the government. But with this digital disruption happening, there is something else happening in the background, because the kind of human capital India offers and services blooms wherever the human capital is skilled and the infra needs are limited. You don't need land, labor, reform approvals to be that stringent. Even if the government policy support is not as much, that's the kind of boom India is witnessing, and that's married to the digital boom as well. I'll start with the IT services sector. In fact, when we speak to our top IT clients, they're actually telling their CEOs, are telling our CEO that they actually see multi-year growth trajectory post-COVID. So that's the kind of growth you see, but it's in a specific segment. That's IT services, software services segment, where India actually exports a large part of it to US, Europe, Canada. And can you imagine pre-COVID, the number? I'll give you an example. Pre-COVID, the monthly software services exports on a net basis, we have an import as well. That was around $6.5–7 billion. So on an annual basis, it would total around $84–85 billion. Means the range was 80 to 85. Post-COVID, there's been a threshold shift to $8 to $8.5 billion on a monthly basis, which means the threshold on an annual basis shifts to $95 to $100 billion. In fact, it may actually exceed $100 billion this year itself. So in 4 or 5 years from now, IT companies expect this number to be $150 billion. And I'm not talking about gross numbers, I'm talking about net IT services exports number. And this is the biggest boom India is witnessing, where India is a leader in global market. When it comes to manufacturing, we are not a leader in terms of global markets, global exports. People look to China or Vietnam or Philippines. The South Asian space is catching up. Yes, one of the panelists did talk about China +1 strategy, where given the geopolitical dynamics have shifted post-COVID, the economies want to look away from China, want to limit dependence on China as a source of key raw materials. So in this China +1 strategy, India can benefit for some sectors. For instance, I'll give you an example. In this whole digital disruption boom, and with the government also inviting a lot of people, a lot of global players to come to India and make use of our MSME strength as well. Apple's largest input provider, Foxconn, is looking at Indian smaller units, manufacturing units in India, to produce inputs for them so that they can eventually supply to Apple. So yes, this disruption is also partly government support, but partly because the e-commerce space that's building up, that's the other sector to be in, which is around $60 billion in India right now, just 2% of GDP. And it may touch close to $200 billion by 2025 itself, given the pace it's growing. It's actually taking our corporates, it's making our local corporates move global because of the kind of marketplace opportunity that's being provided by the e-commerce industry. That's the second industry to see that disruption. Third, very important, is that, and you would have heard in the first panel itself, the financial sector disruption. Today, when we speak to our clients, while I'm part of the corporate office, if any of you gets hired in the retail segment, in the branches, you will realize what Sir also said, we don't visit branches anymore. And that's a big change post-COVID, which is the kind of digital disruption happening. Even banks want to move away from brick and mortar model. And they want to offer, WhatsApp banking. Actually, if you see, and this is something interesting, which someone in the retail space spoke to me about. Today, this week itself, we had the PTM IPO. the market correction alongside, we know that Paytm has been a big disruptor in the last 1.5, 2 years. From our vegetable vendor to our shopkeeper, I mean, for everything we want to use Paytm, for electricity bills, for anything. It's been the biggest disruptor. And the interesting thing is Paytm is offering you a payment system without having any branch, any brick and mortar model approach. So I'll just end by stating that yes, technology is a big disruptor in the payment space, in the startup space, and the shift it's leading towards, in my view, while yes, technology is a disruptor in the manufacturing space as well, but it's leading to more automation, more shift in jobs, lesser reliance on labor, more on capital as factors of production. But in my view, it's also leading to more bias in the growth model towards services. Because when you talk about IPOs, startups, unicorns, 3 a month created this year, more than 100 unicorns in India today. We talk about software services. It's actually shifting to a more services-led growth model. As of now, the bias stays there. But of course, any further comments from other esteemed panelists, more welcome. But services still seems to be a very good space for all of you to be in. While yes, segments within manufacturing are showing signs of a lot of optimism and the entrepreneurial streak shown by other panelists. Thank you.
Thank you, Kanika. There is definitely a sense of optimism today in Indian industry. And we've seen, especially the large companies have reported good financial results even during the pandemic year. And as we heard from the other panelists from the industry, there is a huge amount of investment that is being planned for the future. I'll turn to Dinesh to ask him to look into the crystal ball and see what is the way in which technology is going to impact the industrial sector. I mean, we heard from Kanika that the services sector is already showing this huge signs of growth. But what about the industrial sector? Where do we see the growth happening specifically in which sectors in the industrial sector? Over to you, Dinesh.
Sure. So not only in services, but definitely technology has very great impact on, say, industry sector as a whole. Particularly, I'll talk about, again, energy industry in order to just to correlate, right? What like core infrastructure, like we talked about brick and mortar, right? We did talk about technology. So now I'll talk about, say, infrastructure facility in India, because all said and done, say, energy production, particularly, if you see, it is going through very upheaval in the technology change. For example, if we talk about conventional energy generation, so smart metering and sophisticated equipments are being installed just to remove the leakages in the generation and transmission and distribution section of the power of the energy sector. And without technology, you cannot achieve that. Similarly, when you are going about like say energy sector transition from fossil fuel based energy to green and clean energy, so definitely you need good technology in terms of solar panels, in terms of enhancing the capacity utilization of your plant. For example, in like say 10 years ago, the plant load factor for solar panel has tremendously changed because of new technology, because of improvement in technology. And now even say renewable energy space is giving more productivity, more efficient. Similarly, so in my sense, going forward, like particularly green hydrogen again is like say an explored area. Right now we are producing black and blue hydrogen, which is from fossil fuel. But however, when we are trying to convert from fossil-based hydrogen to green hydrogen, which is based on, like, say, electrolyzer plant, right, which is breaking water into hydrogen and oxygen. So definitely definitely technology requirement is very much warranted. So unless until we have strong technology base, these transitions which we are expecting, which will change the complete cycle, or change the complete scenario of energy sector, cannot be achieved. Similarly, in other infrastructure segment also, particularly automobiles, we are seeing that electrification, if we do electrification of automobile industry, or if we run these automobiles through biofuel, so definitely it will bring more efficiency. It will bring down the cost of running and generating that. And that will have direct impact on the balance sheet of India as a whole. Because if you know, our major bills, our major import is towards energy, right? If we are able to save energy, and that has cascading effect on all factor of production. Because if we are importing costly energy, so definitely you are going to incur more cost on your various factors, various input costs, right? But on second side, if you are able to generate a cheaper power, for example, in say 2010, I remember we put our plant for Adani. So that point in time, so solar production cost, renewable energy solar production cost was approximately 16 crore rupees per megawatt. Now it has reduced to 3 crore rupees per megawatt. So unless until there is a change in technology, so you can bring down the cost, you can bring down the more efficiency in the system, in the infrastructure, and that will pan out. That will change the whole scenario. That will give you a separate or different kind of platform where you can grow and where you can flourish.
Thank you, Dinesh. I agree with you. Just about 7-8 years back, in the energy sector, getting a solar energy parity with thermal energy was a big dream. Okay, but today solar energy is perhaps cheaper than thermal energy. So that's the kind of technological change that has happened over the last few years. And as you rightly said, the solar material has significantly increased the efficiency of the solar panels. Now, if you look at the industrial sector as a whole, there is a lot of challenges that still remain. Banks have still not started lending in the way that we need them to lend, credit growth to happen for us to reach a 30% or a 32% investment ratio. Nikhil, where do you think, what has your experience been in financing infrastructure, getting bank finance for growing your businesses? Where do you think you need more support from the policymakers to make the kind of investments that are required?
I think that's a very, very pertinent question. I think the big support that is required, the best example is the energy industry in this country, with all the discoms not having money to pay to the producers. The expectation is that the energy sector should actually be paying for its coal to Coal India Limited in advance. Now that is something that's an untenable financial proposition. However, what has happened and what's really helped is the Atmanirbhar Bharat scheme, under which a lot of discoms have been refinanced by the government and a lot of companies have got back their dues. So I think as a policy matter, considering that the Coal India Limited is also a government agency and the discoms are also run by the government of India or the state governments, I think as a policy resolution, there could be securitization of electricity dues with coal dues. That's a step that the government needs to take. The other part of it is, if I was to talk of energy as such, electricity today is not subjected to GST. which means that all the inputs that go into the production of power do not really, the producers don't get the benefit of that, as opposed to which we actually pay a electricity duty as power producers. So technically, if electricity was also subjected to a GST at a bare minimum essential rate of 5%, then it will be revenue neutral for the exchequer, while the electricity producers will actually be able to take the SENVAT credit benefit, thereby reducing the cost of production. So that's another policy level support. A lot of producers have gone bankrupt for the reason that the discoms were not paying them while they were supposed to be paying Coal India or any other providers of fuel in advance. So I think as a policy level support, the government should probably, and in this, the poor producer actually pays through his nose to the banks for interest. There could be a policy level change that the government can envisage by saying that tomorrow, if a discom hasn't paid its dues on time, then the interest will not be paid by the energy producer, but will be paid by Coal India Limited, because they got their dues in advance. I mean, I don't know whether I'm talking philosophy here, but that's reality. It's a question of how government takes away your money into one hand but doesn't pay out of the other. So I think that's going to be a big channelizing change. The other aspect is with solar becoming very, very affordable now and distributed solar coming in a big way in the country, the policy level change for distributed solar and your ability to remotely monitor your systems and to remotely raise your invoices would also enable the a huge cut in the administrative spend of the service providers. So today you have somebody who comes and takes a meter reading for your power, right? Tomorrow it may not be required at all if your meters through a chip are connected to a central SCADA system. SCADA is the power plant control system in simplest possible terms. So that can be kind of connected through a computer to a centralized control room, and you could generate invoices directly online, and you could monitor usage of power online. The state electricity boards today pay their power producers an average rate of about 3.25 rupees per unit. And on top of that, they pay a huge amount of about 75 paisa to 1 rupee 40 paisa to power grid for transmission of electricity. And the transmission losses also run into roughly about 30%. Now, if we were to look at something like that, then a policy level support could also come in the form of electricity undertakings. Instead of installing meters in your house, were to install, now meters already there, if they were to install solar panels on each household consuming more than average 10 units a day, then their cost of production of power will fall sub 2 rupees 50 paisa, while their revenues will not remain impacted. So the capital investment actually has the ability of being turned around in a span of less than 3 years. And that's a policy level initiative that the government needs to really take. Thank you.
Thank you, Nikhil. Some great suggestions there. And this brings us to the kind of end of this panel discussion. We've had very, very interesting views from Kanika, who has pointed out how the unevenness in the growth of different sectors and what are the kind of changes that are happening in the economy today, which would take the economy to a new growth path. It was very refreshing to hear the optimistic view of our industry panelists. They all were very, very optimistic about the direction of the economy and the policymakers, the kind of investments they are planning in green energy, in taking India to the next step in meeting its environmental mileposts. So very interesting discussion, and I would like to thank all my panel members for giving their time to participate in this event. Thank you very much. Thank you, Kanika. Thank you, Dinesh, Nikhil, and Manish. With this, I close the session. Thank you.
Thank you.
Thanks a lot. And good luck to the students.
Thank you.
I thank all the panelists for engaging us in this insightful panel discussion. We enjoyed participating in it. At this point, we'll break for lunch, after which there are 8 different workshops that will be held post-lunch. I request all the participants to join their respective workshop on time. We are closing the session now. Have a good day.